for the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
right.
So it's ready right when you pull up your car.
How do you manage these kind of two different staffing needs, right?
Yes.
And making sure you have the right amount of people
yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
Three-day winning streak on the S&P 500 could become 4. Equity futures right now on the S&P positive by 0.3%. Best day of gains of the month so far in yesterday's session, following disinflation. Inflationary data showing some cooling. The Nasdaq up again this morning by 0.7%. Into the bond market, 2-year, 10-year, 30-year. What a ride we've seen on the 2-year. 2-year last week, this time last week, following the ADP report, blowout report. There we go again. Here we go again. Rate hikes, rate hikes, rate hikes, rate hikes. Yields up through 5.1% on a 2-year. And then all of a sudden, back down to 465 on a 2-year this morning. The 10-year right now, Tom, about 382.
Quickly here, what do we hear from Fed speakers? I mean, what do they say now?
So
where does hawkish tilt go?
Barkin said this yesterday. If you back off too soon, inflation comes back strong,
correct,
which then requires the Fed to do even more.
Correct.
Our target is 2%. I think you're going to hear more of that for the time being. Just one report, but really encouraging. Let's see if we get more of it. Just want to finish on the FX market, then I've got some earnings for you. In the FX market right now, the euro near highs of the session, near highs of the year, 111.64. We're positive there by 0.3%. And here we go again on raising the outlook. Delta seeing full year adjusted EPS at $6 to $7. That's the current range for the outlook. They had seen the high end of 5 to 6. So an upgrade there to the outlook, Bramo. Delta in the pre-market up 3%.
Just to give you a sense, new record for industry passenger volume in the month of June. We saw that with records being hit for consumer non-work business travel that we saw over the past couple of weeks. Also saying that they expect their non-fuel unit cost to decline 1 to 3% year over year. Again, this speaks to lower input prices as they charge more to consumers. Very curious at the 10 a.m. call that what we hear about going forward the pricing power, especially after yesterday's CPI report, where supposedly airplane tickets dropped 8.1%.
Sure.
All of us were incredibly skeptical, especially given some of these profit margins that they're expecting.
I'd love to know how they measured that.
Exactly.
I think we all would.
Yes.
Delta year to date up more than 40%, close to 50% higher. Tom, American Airlines year to date, the same amount basically. United Airlines pretty much the same amount. It's been quite a rally for those names.
Well, it begins an exciting earnings season. We'll really dive into this tomorrow. Lisa's really excited about it. It's the wall of earnings we're going to see and to interpret it in real time as we can. John?
Some calls out there on the euro. Want to get to this from Alan Ruskin at Deutsche Bank with a call on the euro against the US dollar and writing the following. The Fed's leadership in the global rate cycle will increasingly play against the dollar as central banks pivot from rate hiking to rate cutting. We expect the euro against the dollar to end the year at 115 by the end of 2023, then extend the trend to the mid-120s in 2024. Tom, you'll love this. Go out to 25 before flattening out in 2025 as U.S. growth recovers.
My experience is people listen when Alan Ruskin speaks. He has the privilege of working with David Folkerts Landau and putting together holistic global research for Deutsche Bank. Their chief international strategist joins us on what I'm calling from Steve Englander Game Changer Thursday. How much did the game change yesterday, Alan Ruskin, with disinflation codified in the United States?
I don't know whether disinflation was codified, but things did certainly change substantially in the FX market. We've been entrenched in this incredibly narrow range, really, for most of this year. Euro-dollar in particular was seemingly capped at 110.90. And I think once we broke that level, it's opened the floodgates in a way, and the dollar is on the defensive pretty much against all currencies. So it's codified a change, as it were, in the FX market, Tom.
I looked at a very fancy regression of the blended DXY index back 20 years, and certainly off the great financial event of 2008, I can look for further 8% dollar weakness. Do you see that kind of scale to go further with dollar weakness?
Tom, I do. When you look at these big dollar cycles, historically we used to have, sort of 6 or 7 years of dollar uptick, and then 9, maybe even 10 years of dollar famine, as it were. This last cycle got broken up a little bit because of COVID in particular, and we had a bit of a longer uptick. But the downticks, the down cycles are typically in the order of about 25% down on the trade-weighted index. So we've probably gone maybe a quarter of the way through a typical down cycle. So even if we have, a half a cycle, we could certainly get that 8% that you suggest, and it could be substantially more than that.
When does fundamental growth matter again, Alan? I mean, we're talking about the rate hiking cycle, we're talking about inflation, but it also is a question of fundamental economic strength that the U.S. seems to be displaying, even as Europe faces a lot of headwinds and potentially more rate hikes into weakness.
Yeah, the way I look at it, Lisa, is that there's a continuum where you think in terms of strong growth, a sort of no landing situation, then a soft landing story where you could even have a recession, but it's a shallow recession, or you could have, really amounts to, say, a hard landing where the Fed pushes to the point where something really breaks. At the moment, in that continuum, you've shifted towards more of that sort of soft landing arena with the Fed pivoting in 2024. And that's the worst scenario as far as the dollar is concerned, because risk trade's okay, and bonds in general like it, equities like it, but the dollar really doesn't like that scenario. So the dollar tends to do poorly against G10 because of the Fed pivot, and it doesn't do well against EM because risk usually is trading okay as well.
And to that point, Alan, I'm thinking about typical cycles when the dollar does worse. Usually that is a risk-on scenario, risk-on in emerging markets, risk-on around the world, a sense of growth. How does that dovetail into the potential weakness and greater weakness in other non-U.S. areas at a time when the U.S. is actually shockingly resilient and showing a much faster pace of disinflation?
Yeah, I think we're certainly looking at the U.S. being one of the slowest major economies in terms of GDP growth for 2024. The U.K. will probably outdo us on a GDP Q4 basis for 2024, but the U.S. is pretty much up there. So we're not seeing and do not expect that other economies will quite match the degree of slowing that we anticipate for the first half of 2024. Obviously, if that doesn't materialize, that gives the dollar a little bit more of a boost because you're not going to get the rate cuts that we're expecting for 2024.
Alan, where's a tradable pair here? I mean, it's one thing to say, euro higher, but where's the opportunity here, the big figure trade that you would suggest for Deutsche Bank clients?
Yeah, I think if you want, sort of a souped-up euro trade, then I like the Norwegian krone particularly. I think it's grossly undervalued by every metric that we look at: PPP, DBR, FIR. I can throw out acronyms galore, and they all tell you the same story, that the Norwegian krone is grossly undervalued. So in a world where sort of high betas are trading okay, the Norwegian krone has got a long way to go still.
I mean, you got Norway there. Is that an oil play where it's just simply a linked into a Deutsche Bank recovery in the price of oil, given better times, given better global demand?
No, I think it's more of a high beta euro trade, really. It's got drawn down and pulled down a little bit by the Swedish krona, which is had its own set of problems that don't necessarily relate closely to Norway, but it's getting tagged along. Right. But no, I see this really as a euro play, but with a high beta currency that's extremely undervalued.
Alan, I featured at the top today the absolute shock of a peso comfortable 21.20, and imagine Mexican peso strengthening through 17. I didn't frame that. How can that happen? How does Mexico improve from here to 15 or a 14 level?
Yeah, I think people have been playing the Mexico trade now for a couple of years, and you just saw a little bit of a squeeze because, a lot of people were long Mexico versus the yen, and the yen side of things squeezed quite badly. Look, I think the Mexican fundamentals have been remarkably resilient for, a couple of reasons. One, it's underbanked as such, and there's very little leverage in the system, so that when rates go up, the Mexican economy does prove pretty resilient. And then I think there's a structural story and a structural play, whereby people are relocating, closer shoring, as it were, to the US and away from Asia and China in particular. So I think those elements are still there. The data still looks okay. When the trade accounts start to deteriorate, we know, and we'll get the much stronger signal that the Mexican peso is more significantly overvalued. At the moment, it looks overvalued on a real exchange rate basis, but we don't really see it in the trade data.
We're speaking with Alan Ruskin of Deutsche Bank at a time when the dollar is the strongest going back more than a year. You can see the euro ascendant. The possibility, as Alan projects out, of a 120 euro. Good luck to all of those European vacations that everyone's trying to clock in right now. I'm wondering, Alan, from your perspective, how much of a boost this will give U.S. businesses, international businesses that have suffered with a strong dollar in terms of their sales overseas. Does this in some ways give a headwind to U.S. growth down the line in a sort of on the margins level?
Yeah, I think, Lisa, you used the right word. At the margins, this is going to be helpful for U.S. corporations, helpful for exports, helpful for the equity market as well. So, we've got some constructive elements there. Exports have held up quite well in the grand scheme of things in the U.S. relative to other countries. So, this is going to be a further boost. I think there's some very helpful things happening in U.S. manufacturing. The defense industry is obviously doing extremely well. You've had this relocation in terms of semiconductor plants, back to the U.S. You've got some very helpful elements there. So I think this is all the more good news as far as the resilience that you were speaking about earlier.
6 days of dollar weakness against the euro. Euro dollar 111.67. Alan Ruskin at Deutsche Bank there on the FX market. Let's turn to the equity market just briefly. Equity futures with a lift on the S&P 500. Likewise on the NASDAQ. We need to look at two names reporting earnings this morning. Beat and a raise over at Delta. Beating earnings expectations, raising full-year guidance. Ed Bastian speaking to Bloomberg saying this: there is significant growth ahead. Flying, Tom, the number one priority for discretionary spending. That stock in the pre-market up by 3%.
I wonder where we are in 12 months. And I say this, John, because to me, it's almost this economic babble we talk about, a jump condition. I go back to the images this weekend of an Acropolis in Athens absolutely overwhelmed with tourists. And my anecdotal from my family is it's happening everywhere. How is that happening? And I guess from the airline standpoint, how can they sustain that? There's just, is it a post-pandemic once-off, or is it something beyond that?
Well, Tom, to that point, there's a range of theories, a range of data points, and you get to decide how much weight you put on each. What we did with goods was bring all that demand forward in the pandemic. What we did with services was push it all out. And we're experiencing that over the last couple of years. If you take the Neil Dutzer view of the world over at Renaissance Macro, real income's positive, better, inflation down, wage growth great. That's one thing. Or you can look at things right now and say, look at the savings power coming out of the pandemic. It's dwindling and things might get harder later this year.
I brought this up on Twitter overnight. You just absolutely nailed it. And this is from Justin Wolfers, the wonderful economist from the University of Michigan. And somewhere, he should go to the White House just to bring some Australian levity into the White House. Wolfers is saying it's like a serious marathon.
You think we need some Aussies?
Yeah, we need some Aussies in the White House. And, we can't get them in a Fed, so Wolfers can go to the White House and help Brainerd. And the answer is Justin Wolfers had the chart you just described. And guess what? The real wage line crosses the inflation line. Fact.
There is another story that we have to point to when we take a look at the airlines. They said that spending on jet fuel dropped 24% on lower prices per gallon. When you talk about how much lower their expenses are, well, there you go. There are other expenses also that they're coming in as they strip out all of the luxuries or even any kind of amenities whatsoever that you're used to experiencing on those planes. I'm just saying, editorializing. But my point is here that they're facing these declines that might be one-offs, right? How much is the entire conversation influenced by lower oil prices in a way that has been pretty dramatic and unexpected?
For the consumer as well, not just for
Exactly.
the airline. Nice of the airline to pass those cost savings on to the passenger.
A little bit of them.
Yeah,
8.1% maybe.
Sure. Really feeling it.
Yeah.
Is that what CPI captured yesterday?
Yeah, exactly.
I still don't understand what that was about. You have your real life experience, personal experience with the world.
Really tell me about
and
it.
airlines.
Let's talk about your personal
Sure,
experience.
we can do that. And then you have the CPI data tell you that airline fares are down, and you're like, are they?
Yeah, well, and maybe they're down, but then you get no peanuts, you get no chips,
No chips,
no
no
Cheez-Its,
drinks.
no drinks.
Chips.
Got to pay for
Grandma's
your bag.
upset with Delta. Let Ed know.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
From New York City.
In London, in Sydney,
From Washington.
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this
Is
story.
there the kind of upside?
We still have a lot of problems. We have too much concentration in the banking industry. We have more too big to fail banks than we did back when the economy crashed in 2008. And the too big to fail banks are bigger than they were back then. So, you know, we're not out of the woods yet, but I feel a lot better when I read Michael Barr talking about how we need to tighten down on bank regulation. Go, Michael.
Senator Warren never said that about Quarles, did she? Hey, very different tone. Senator Warren there of Massachusetts. Do you think in another 15 years, this is all Senator Warren will be talking about, 2008? Another 20 years, 25 years, 30 years, 35 years?
I take immense issue with her critics who treat her with a certain level of buffoonery. She is world class in bankruptcy law. This is a legit professor. Okay, maybe it's not bank regulation or bank supervision, but there's at least an adjacency to it. How many other politicians could we say that about?
Tom, I would agree with you,
Yeah.
but plays politics with every single financial issue that comes to the surface.
In
Every single
a
one.
certain liberal Massachusetts way. There's just a certain Charles River way that you...
Now, I'm not here to defend too big to fail and massive banks and financial institutions. What do you think would have happened in March if every bank was the size of SVB?
Oh, I think as people well know, I'm completely the other way. I mean, I adore the Canadian model. I think the Canadians do it right.
Randy Quarles kind of responded yesterday. He came out and he was talking about how if Michael Barr goes through with this, it will be very harmful and unnecessary. So pushing back against the idea of raising more capital. I take your point. Elizabeth Warren, highly qualified, but she also kind of puts herself out there by saying, just stop, just make it stop, And there, it's obviously an incredibly complicated discussion about what to do with rates, and she knows that as well as anybody else because she is a highly educated professional.
It's going to be interesting to see.
But do you all want to say that again just to make sure you got it across, with the utmost respect?
Well, I do have the utmost respect. I'm not kidding.
Do you think the rant about the rate cycle over the last 12 months has been helpful?
I think,
Yeah, sure. Very educated, though. That's good to know.
John, I'm going to pick out one data point here on the screen. It's the real yield coming in from 1.80 to 1.54. That's a clear indicator of the disinflationary tendency.
Nominal yields, Tom, with a big move. We're down 10 basis points. 2-year, 464. We were through 5.1% only a week ago.
We need to get you to Friday, where I thought it was a jobs report, and John corrected me gently and said, hey, stupid, it's about banks. In charge of banks, Erica Najarian joins us now, large cap banks and consumer finance expert here at UBS. Erica, just a general question to begin the discussion. What will you look for in the beginning of the press releases tomorrow, into Monday, into Tuesday? What is the theme, the tendency you will look for?
So there are really three things that I'm going to look for. First is capital. Like it or not, a lot of investors are laser focused on capital and how banks are building capital, not just because the rules are getting tougher, but also because there continues to be uncertainty in the economy in terms of the outlook, no matter what the macro prints are saying. The second thing I'm going to look at is net interest income and how deposit costs and deposit growth are trending. Although a lot of investors are thinking that we are in the late innings of that being a catalyst, a negative catalyst for the stocks. And the third thing I'm going to look for is any signs that credit is deteriorating underneath the surface. As you know, all three of you know, the market is very sensitive for, any hiccups in commercial real estate. And so those are really the top three things I'm going to look for in Friday.
How do you weight your large cap world with the super regionals, the regionals, and the SVB, like the smaller banks that are out there? What's the level of importance of the next 3 or 4 days versus everything else in bank earnings season?
Well, I'll say that it's probably an even more pivotal time for the regional banks, particularly the super regional banks that are within the scope of the Barr speech with regards to new regulation. So I think that JP Morgan, B of A, Wells, Citigroup, Morgan, Goldman, those are institutions that have gone through the first iteration of the rule change when we went through, the Basel III framework and put on these new capital rules and new liquidity rules sort of post 2008. So we have clear evidence that they've been able to survive and thrive under that regime. I think the super regionals are in a different spot where regulatory rules are getting much stricter for them. And so they sort of have to balance and tell their investors how they're going to deal with that. Are they going to continue lending? Are they going to pause buyback for longer? How are they going to grow capital? The good news is that the Barr speech is indicating that these super regional banks do have a lot of time before these tighter capital rules become final.
There is a question, of course, also around some of the largest banks. Goldman Sachs, in particular, has been guiding down its guidance pretty aggressively, and with a break from some of its past practices in terms of not giving intra-earnings guidance. This is likely to become the worst quarter since David Solomon became the CEO. This, according to Mike Mayo over at Wells Fargo. What are you expecting, and why the negative kind of results that we're expecting?
So, Lisa, not to defer your question, I actually don't cover Goldman Sachs, but given the vagaries of, trading volatility, investment banking volatility in the quarter, a lot of the banks have been, giving mid-quarter updates, but also saying that a lot can change over the next few weeks.
Going forward, what is going to be the main pressure that you're looking for? Is it going to be loan losses, loan loss reserves at the big banks? Is it going to be interest margins? Is it going to be how much the deposit beta is increasing as they try to compete for deposits?
That's a great question. I think that because the bank failures put deposit costs and deposit growth in the spotlight, it feels like that is already priced into the stocks in terms of further pain. And I think the CPI print gives bank stocks some relief as we can see the light at the end of the proverbial tunnel in terms of Fed tightening. You know, I think the one thing, and the Barr speech was pretty much down to fairway, so to speak, with regards to what the market is expecting for further regulatory tightening. I think the biggest hurdle for investors in terms of, you know, buying bank stocks here, despite the valuation, is that specter of credit. And so I think that's really the one thing that everybody's looking over their shoulder and saying, is it really time to buy bank stocks? Because I don't know what's going to happen in the economy. And maybe the last thing I really want to do is own bank stocks into a downturn.
Erica, very quickly, we're out of time, but what's the single best buy right now? We're going into earnings season. We're going to tape this, play it back on Thursday. What's the single best buy among the big banks?
Bank of America.
I thought, oh, okay, that was short and brief. Thank you. We'll have to have her
you
back
did
on
ask for a single best buy. You know,
single best buy, Bank of America.
No, Erica assumes we're up against the clock, Tom.
Yeah.
You know, it's the right thing to do.
Okay.
Erica
I follow instructions, Tom.
UBS. Erica, thank you.
Thank you, Erica.
B of A, TK.
Well, look, you know, one of the great moments of, I think, in the last year, the last time, John, we were in Davos, which I think was 6 months ago, and a basic idea, we talked to Brian Moynihan, and you and I decided we weren't going to ask him what the Fed would do. We actually talked to Brian Moynihan, folks, I'm sorry to say, like we would talk to James Dimon. Good morning, Joe. And, you know, I talked to them about banking, and Moynihan was encyclopedic on operations, and that's what you want to see.
I feel like we do this every quarter. Just for the record, I'm pretty sure I've asked Brian about Fed policy once or twice. I will say this, though. What he's great at, and what I think he is brilliant at, and I've said this a million times, he's one of those CEOs at a bank which seems to trust and have faith in his research department.
Yeah.
So when he is asked about those things, he knows what his research department thinks about them, and will go out there and say what Mike Gapin is thinking about Fed policy, what the team is thinking about the economy. If he's asked about markets, he can lean on some of the research from Savita Subramanian. You know, that kind of makes sense as a leader of a financial institution, and I have a lot of respect for Brian for doing so.
Yeah, I think it's true, and of course, with the case there, and this is Erica's buy, not our surveillance buy, but the idea here of Moynihan picking up the pieces out of the great financial crisis from Ken Lewis. And you know, I was mentioning this to somebody the other day, and I realized the person I was talking to had no understanding that Bank of America is not a bank in San Francisco, or Wells Fargo is not a bank with a stagecoach. These are melded together, wide sets of mergers, sometimes under stress.
Do you think people thought that Wells was just a bank that went around with a stagecoach?
They would like you to believe that their heritage is a stagecoach going across the plains of America.
Right.
That's
Might have
the
been their
BS.
heritage.
That's the, I don't even think it's that. I'm not even going to go there. My point is they're avoiding, it's just like they avoid the fact that they make too much money. They're avoiding the fact they're a merged hodgepodge of 30 entities.
Your friend from Massachusetts would like them all to go back to just being
Stagecoaches.
Stagecoaches that go across the country.
They have a stagecoach in Minneapolis.
Did they?
Yeah, I've been there.
Cool, nice. I'm sure you have.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on that folks are so excited about it. Climate tech is the hottest area to be in.
Venture capital. It's been volatile. From bank crisis anxiety to AI exuberance, Caroline Hyde and Ed Ludlow chat with the biggest names about the latest tech trends.
Is AI going to dominate the earnings narrative for this sector this week?
I think we're seeing opportunity and potential platform shift that we haven't seen in a long time.
If you're a company today and you're not embracing the changes that are taking place with AI, you're going to be behind.
How do you prove to the investor base that you haven't just tacked on AI to make yourself sexy?
It's very hard to differentiate if you're not experienced with AI.
The startup stories.
We think this is a watershed moment for technology.
Certain categories are more exciting than others. Right now, obviously, generative AI is a category that is very exciting to startup founders, customers, and venture capitalists as well.
So what we are seeing is a new area of opportunities for new founders to come and change the industries that matter.
And the real talk on realistic valuations.
Some of the best opportunities are sitting right in front of us.
How do you discern which ones are good on the marketplace right now?
I think founders have woken up to the reality that taking on more money at higher terms doesn't necessarily play to their benefit in the long run.
How do you actually invest?
Follow the VC money on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West, only on Bloomberg Television. Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
But are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Messer and Tim Stenivek bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
On the David Rubenstein Show, Peer-to-Peer Conversations, I uncover the untold stories of the world's most successful leaders. Watch Wednesdays on Bloomberg Television.
Our studios in New York and San Francisco. Our expert hosts of the data and analysis about the companies you know and the startups to watch. Plus, the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority.
We've constantly underestimated the resilience of this economy, but we are seeing some moderation.
There is a long and variable lag to tightening of financial conditions into the real economy.
We're seeing disinflation everywhere. We're really seeing deceleration and disinflation in the U.S. economy.
We're seeing disinflation in the U.S. economy that is, gradually becoming more broad-based.
I don't think it changes the move in July from the Fed. They can't take their foot off the pedal yet.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Three-day winning streak about to become 4 on the S&P 500. Live from New York City this morning. Good morning, good morning. For our audience worldwide, this is Bloomberg Surveillance alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Your equity market positive 0.3% on the S&P. Let's see if that sticks. It's on to earnings, away from the data. JP Morgan, Wow, Citi tomorrow morning. This morning, PepsiCo and Delta. Pepsi with a beat, Delta, Tom, with a beat and a raise to the outlook.
Looks like what we saw 90 days ago. I think I mentioned this yesterday or the day before, is that the risk that's out there is we repeat what no one's imagining. I remember the shock and awe exactly 90 days ago when, oh, the revenue growth is pretty good, isn't it? I think that's what I saw this morning.
Delta in the pre-market up 4%. PepsiCo up 2.4%.
Frito-Lay up 14%.
Revenue?
Yeah,
impressive.
Huge response on Twitter, Cheez-Its and all that.
You check out Quaker Oats as well, Tom?
I didn't
get into it. Dig into it. The eye-catching move is beyond the equity market and into the bond market. Yields are lower at the front end of the curve by 10 basis points. This off the back of the inflation data just yesterday. Lisa, there's quite intuitive dynamic off the back of that information. Yields down, aggressively so on a 2-year, as you mentioned, Tom, and a dollar weaker against the euro.
Strategists also basically saying that the July rate hike, which does seem to be a lock, will be the last in this cycle. And that seems to be an increasing conviction that you're seeing both in Fed funds futures pricing as well as in some of the analysts' notes. Key question to me is, what does that imply for the backdrop? What does that imply for the labor market? And every analyst that's come on has said they are waiting to see when that cracks, if there are delayed implications from some of the hikes that have already happened. or if we've achieved it, if we're there, if it's nirvana.
I want to hear from the lonely bull crowd, the people that have been on board this rally. I think they've been relatively quiet. John Stolfus at OPCO on economics, Neil Dudd at Renaissance. I really want to hear the bull readjustment to the game-changing news of yesterday.
The people who had a tough year last year having a better year this year. The people who had a good year last year.
Yeah, I think that's fair. I think that's very fair and understated.
There are some financial institutions, I can think of one that had a tough year last year and a tough year this year, and talk about that
but I think what you just said, John, is a really important observation, and so it's the then what, and that's where we are into the end of this year.
Well, let's talk about where we are right now. Equities are firmer on the S&P 500. The earnings this morning, relative to expectations, are better. Equity futures at the moment up by 0.3% on the S&P. We mentioned the US dollar. It's weaker off the back of those lower yields. The euro, this is a 6-day streak now of the euro stronger against the US dollar, Tom. 6 days, longest streak since January.
I haven't said this in ages. I thought Alan Ruskin of Deutsche Bank really captured it perfectly, but suddenly foreign exchange is a litmus paper of the system, and you see it in EM. I don't know, is Damien with us? Or I can't keep track of Damien's calendar. Is he with us? Yeah. Damien Sessa or in Mexican peso is going to be must listen.
Lisa, euro dollar, 111.70.
I just want to say for the record, Neil Dudd hasn't exactly been quiet. He just recently wrote an article in Business Insider titled "Meet the Wall Street Scaremongers who are totally wrong about an imminent recession." Just saying.
Yeah, but no, you're absolutely right. But I'm sorry, it's Thursday.
Is he going to throw me under the bus?
It's Thursday. What are we going to see in 24 hours after the earnings? What are we going to see at 3 p.m. on Friday? The doom clue comes out to get the clicks on the weekend, and it's just baloney. I mean, it's just not healthy for anybody to consume.
Here's what I'm looking at, 8:30 a.m. Before that incredible sphere, 8:30 a.m. U.S. Producer Price Index comes out as well as jobless claims. Very curious to see the input prices for companies, which is reflected by PPI, expected to come in more than what we've seen over in the headline prices that companies can charge the consumer. That gap is fueling profit margins. Does it start to compress as you see headline CPI come in as dramatically as we've seen some of the declines in PPI? Then today we have already gotten Delta and PepsiCo earnings, a raise and a beat over at Delta. We get the earnings calls at 10 a.m. for Delta, 8:15 a.m. Pepsi. Very curious to hear from Delta how long they can keep airplane tickets high, the prices high at a time when we just heard yesterday from the CPI report, they came in 8.1% at Bastion saying this, and John pointed to this earlier, flying is the #1 priority for discretionary spending, and I can say that does check out in certain sectors. 6:45 p.m. we hear from Fed Governor Chris Waller. He is the latest when it comes to Fed speak today. Does he basically say, we're there, it's it, this is the soft landing? Does he say we have to do more? Does he say we're concerned about X, Y, and Z? Or does he kind of give a sense that, yes, this will be the last hike in the rate hiking cycle?
Ramo, forget the Fed. Go rogue. Look down the camera and tell us what you think of Delta. Just, just everyone wants it. Been waiting for it for months.
I think Delta is a fabulous airline.
Okay. Troy Gayeski joins us now, Chief Market Strategist at FX Investments. Troy, I'm not going to ask you what you think of Delta. Let's start with this market. A, is this a melt up? And B, if it is it a melt up you want to be a part of?
Yeah, so it's certainly late stages, we think, of this recent revaluation. Remember, we took multiples back to 15.75 in October. We're now at 19.3 next 12 months earnings, assuming no recession. But that being said, melt-ups can last much longer. We think could be as much as 5% more upside here. And, Lisa brought this up before in terms of the labor market and labor market cracking. And there are still some incipient signs of that in terms of payroll growth and withholding tax growth. That already rolled negative last quarter and is even more negative so far in Q3. Obviously, we're very early. So when we look forward, recession is not a guaranteed outcome, but it still looks very highly probable to us, a mild one. And that just means earnings estimates will have to be cut. And, when you have the lowest equity risk premium since the dot-com bubble days, and you have multiples back to almost where they were at the end of 21, the risk reward of equities are just not terribly attractive here.
Troy, you are the most competent strategist I know on the dynamics of the street wrapped into the strategy. And with your work over the years with hedge funds, I want you to talk about what I see every Friday afternoon, which is the analysis of short covering. At some point, short covering plays out, doesn't it?
Yeah, and look, when you go back to when this rally started, a lot of it was short covering, and that's continued throughout really the last 3 months. And, we think we're just about to the end of that cycle, but this goes back to John's point before in that, strategies that performed extremely well last year have really been pummeled. And part of that has been anything that you've been short has been highly problematic. But over the next several weeks, it does look like that technical will play out. And then the question from there to see how much further this rally can go is, does some of that $5.5 trillion in money market funds start chasing this rally and chasing this rally aggressively? If that's the case, then, this could be a year not like 1999, but certainly something that has materially more upside even from here. And then, unfortunately, what that means for investors is the starting point of valuations going into 24 will be highly problematic for the next 5 to 7 years equity returns. So yeah, it's a tricky environment to trade, that's for sure, Tom.
Where does the money come from that could pile into equities? And I say this at a time when we've heard so many people say that there's money on the sidelines, but that's kind of an inaccuracy. That's kind of an anachronism because it's either in cash or it's in money markets. It's somewhere. It's not just sitting under someone's bed. So where does it come out of?
Well, yeah, so again, you have $5.5 trillion roughly in money markets. And, even as the Treasury's been replenishing their checkbook very aggressively, most of the cash that's funded that has come out of reverse repo. So if you get a risk on impetus, meaning we end up somehow, some way not having a recession, and some of that $5.5 trillion, it doesn't have to be $1 trillion, but 200 to 300 billion starts rolling in, then you get the next leg higher, which will confuse people even more that look at fundamentals of markets and the economy. Because basically on every metric, we're at extreme valuation levels. And based on every metric, it looks like the forward trajectory of the economy will go into at least a mild recession.
Which makes me think about what Yuri and Timmer over at Fidelity had to say, that the market always inflicts the maximum pain on the maximum number of people. And this 100%. Could be the last gasp where it brings everybody in full capitulation before you do see some softening, because there has to eventually be some softening. That's what happens. It could happen in 2030, but it eventually happens. Is that kind of the setup that you're seeing right now?
Yeah, it's really that classic setup. And, you and I talked about this a couple weeks ago, Lisa, in terms of capitulation on both sides, right? When you have bottoms like we had in October, you have capitulation on the perma bull crowd or those that have been overly bullish. And when you have these sustained rallies that are just so painful to anyone that's been, let's call it non-constructive, not as positive of markets as Dud has been, you can have capitulation the other way. But then when you look forward from there, it's really a similar setup to the end of 21 where you have very elevated multiples. But the difference now is 22, remember, that was all about Fed tightening, aggressive tightening. The Fed is just about done with that in terms of the front end. We hope they only hike one more time. They probably shouldn't do that. And then from there, they drain their balance sheet. The next 12 months is all about whether the probability of recession is 60 to 80% like we think, or only 20 to 30% like markets are pricing in right now.
Great to catch up, Troy. Appreciate it, as always, buddy. Troy Gajewski there of FS Investments. Neil Dutta, Renmac, just phenomenal over the last few months, Tom. Just turn around and say things might be better than you think they are. Check out the home builders, check out the home builders. New highs on the home builders, by the way.
I just think it's companies adapting and, frankly, society adapting. Let's make clear here, as I'm sure Senator Warren said yesterday on Bloomberg, there's a huge part of society not participating in this. And just look at the commercial real estate and the residential real estate challenges across America. But with that said, A, it's a nation with what, 1-2% GDP, maybe more, and B, on a relative basis to other economies, on a global basis, we lead.
The home builders from last June, just looking at the chart, they're up close to 100% from the lows of last summer.
We're all going to die.
It's pretty amazing to see that develop.
Especially at a time when supposedly the housing market's supposed to be falling out of bed. And in fact, home builders are the only inventory that's on the market because nobody's moving, because who's going to cash out of their mortgage rate? So this is really a dynamic that has just kept on giving for them.
In the walk-up I'm living in, they had eight vacancies, which is a lot versus the last 2 or 3 years. They rented 5 of them in one day. They had 8 vacancies. They rented 5 of them.
How is that walk-up going?
And walk-up's going okay.
How's that going? Good.
You walk up how many flights? 50?
6. No.
56.
Yeah, exactly.
I lived in that building. I know the floor.
Yeah, that's what I think.
Tom, you always gauge how many brown boxes there are How many brown boxes
That's
are there?
unbelievable. The Amazon thing. Joe Feldman out at Amazon raises his price target off of Prime.
Nice.
John, did you do Prime?
I did do Prime. Prime went on for 2 days, though. I forgot that it wasn't a day. It's Prime Days.
Joe Feldman
lots of protein.
raising his price target $20.
Lots. If you are just tuning into the program, welcome. Special as always on the S&P 500, positive by 0.3%. Coming up, 8 a.m. next hour, Ed Yardeni of Yardeni Research. I remember not so long ago he had this target of, what was it? I think something like 4,500. And then he said something like, maybe I'm not bullish enough, Bramo. Maybe that's the big risk. That was only a couple of months ago.
And I remember Tom's response, whoa, can we make some news? 5,000? And he's like, at some point we can get 5,000. Well, now he seems actually prescient because it seems like we're headed toward there and people talking about resistance at 4,650 or I don't know. And then it keeps going from there.
Ed Yardeni does what any Yale PhD would do, frankly, is extending x-axis. And that's what the Gloom crew did. And the Gloom crew was worried about the next report, this, that, the next Fed meeting. And that, a guy like Yardeni and frankly on a technical basis, and Comport and other bulls are looking out 2, 3, 4, 5 years to how it sustains. My mystery is, what if technology doesn't give up the, it's assumed that technology can't go further. Okay, what if they do go further?
I think we said that about
Apple's $5 trillion company
50 percentage points ago.
Yeah.
It's up 200% year to date now. You never told me about Prime Day for you. Did you get involved?
No, I didn't get involved.
Prime
That bill's
Days?
on there. Bills, I get home last night, and there's a stack of Hill's dog food.
From Chewy?
Like this, from Chewy. And it's addressed to Car, Kennel Fee. It's addressed to, I don't know about it.
Face cream. All about the face
It's
cream.
all face cream. Is that what you got? Oh, okay.
Protein, face cream, dog food.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Lots happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio. Season is coming.
We're going to see cracks start to emerge. This earnings season could be a little bit choppy.
This is going to be an earnings season mystery.
Bloomberg breaks the numbers first.
Those earnings just crossing the wire.
Up by 25%.
Absolutely blew out of the water expectations.
With exclusive expert analysis.
We're starting to see earnings recovery emerge.
AI will be a huge boost of revenue growth.
We're not going to see the same follow through in terms of the price reaction.
Second quarter will be where the rubber meets the road.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
Obviously, today's data and the string of data that we've been seeing does give, a positive outlook in terms of inflation coming down. My general sense is that our economy remains very resilient, and we are seeing inflation come down with a robust jobs market.
Leo Brainerd there, the former Fed Vice Chair, now Director at the National Economic Council, advisor to the President of the United States. If you are just tuning in, welcome to the program. Equities right now positive by 0.3%. Decent run of gains on the S&P 500. 3-day winning streak could well become 4. A lift to this market, not just on the S&P, but on the Nasdaq too. Into the bond market, yields are lower. After yesterday's move lower, we're down another 4 basis points on a 10-year to 382. On a 2-year, we are down another 8. Just off lows of the year, or rather lows of the session, to be precise. The 2-year 466. The 2-year actually dropped to as low as something like 350 something.
Stunning.
At one point, and then came all the way
505.
back. It's been kind of amazing to see what the 2 years done year to date, Tom. Last week through 5.1%, and then coming back off the back of this inflation data in the last 24 hours. PPI, by the way, out a little bit later on this morning.
Was it like 3 cups of Tang ago? We were modeling out 6% money market funds.
I said, Tom, coming out of SVB, we dropped to 355 at the lows of March. This is on the front end of the curve on the 2-year. Then just last week, post ADP, drew 5.1%. And here we are again talking about, no, the Fed's done. Yields are coming back in again. Bramo, you just wonder where we're going to be next week.
Yeah, well, again, narrative shift. Give it another week. All of a sudden, it'll be recession. Oh, my gosh, that's the worst thing ever. Please, can we get them up? We need inflation. We're going to go to a deflationary spiral.
This is a really, really important point. You're dead on, Lisa, about narrative shift, except if you avoid the narrative shifts, 1 year trailing S&P up 15%. The market's just moving right through the narrative shifts that are going on. One final message, Lyle Brainerd out. She can take a victory lap from me. Her concept of cumulative. We're at the White House Correspondents' Dinner, you know, and there she's sitting with Bloomberg, and people are like, cumulative, right? And I think, John, you reached over to get a, you know, to have her pass the wine to you, and you know, you talked to her about cumulative.
I'm really trying to bite my tongue. This is aimed at no one specifically at the Fed. We cannot sit here and say the Fed deserves a victory lap.
I didn't say that. I said Brainerd does.
I know you did, but I don't think you can talk about anyone attached to the Federal Reserve as deserving of a victory lap. These are the individuals that did not want to begin a hiking cycle based on the belief that inflation was transitory. Now, just because that things are rolling over now does not mean they were right 2 years ago. They were wrong. They carried on doing QE.
That was 2 years ago. I'm talking about the last 8 months.
Sure, I know, but I've seen a lot of that language in the last 24 hours, that the Fed deserves a victory lap. Based on what?
They're modeling through where we are in terms of restrictive, or as Dominic Constant says, super restrictive. And you heard that from Tony Dwyer, who says they're 100 beeps too high right now, which is his statement, not mine, as well. Let us stagger to Jeanette Lowe, who saved the show, Managing Director of Policy Research at Strategas, a Baird company. Jeanette, I'm absolutely fascinated how America digests an end of inflation, a disinflation. To me, it's a two-part America. There's an America prospering now, and there's another America, which the policymakers in Washington have to deal with. It's not participating. Is the divide that great?
Good morning. So, I mean, this is definitely something that is going to be watched by policymakers. You know, they have been fighting about inflation for quite some time against the Fed, and now asking the Fed to stop hiking. So there's going to be some careful watches as we go into the next half of the year to see how is inflation impacting the economy, and what does that mean? So, I mean, I think that obviously the U.S. has been surprised by how strong the economy has held up till now, and how much the labor market has held up. But there is definitely going to be some concern as we move into the second half to see how much does another hike or two from the Fed have an impact on the U.S. economy, and then how does that have an impact on U.S. consumers, and how deep may that recession be if we actually get there?
To the immediate, the president's taking, I'll say the phrase to carry it forward from the Fed debate, a victory lap with NATO. He comes home to an American domestic mess. What will he focus on literally in the coming 10 days when he gets home?
You know, I mean, so I think for Biden, this is one of his big things. I mean, he has been focused on his foreign policy. He has been focused on the fact that he is the the counterpoint to Trump in terms of international engagement. So he is definitely going to be focusing on what he achieved out of NATO. I think one of the things that is important is as he's looking ahead to his reelection, he does want to have stronger support for Ukraine in the immediate term. We saw that coming out of the NATO summit. And he also wants to push for, kind of setting up, could there be an end game in Ukraine? Could it be trying to make sure that things are in place so that maybe this could be done before the election comes next year? But over the next couple of days, I think that Biden is going to be focused on what came out of NATO, focused on the fact that we do have more unity within the West. We have more unity with some of our partners in the Indo-Pacific. That was emblematic of this summit. But then he's also going to be focused on some other key issues too, in terms of in his agenda, kind of Lael Brainerd talking about Bidenomics and talking about infrastructure investments, investments in green energy that came out of the Inflation Reduction Act, and chips investments as well.
Jeanette, you talked about something that caught my ear, endgame in Ukraine. What does that look like?
I think people are really trying to put some bookends around what that could be. There is definitely concern, I think, in Washington that this could be a protracted fight, that we don't actually see one side have, come to an end or a complete victory. And so there's trying to be a push, I think, to give Ukraine as many tools as it may have at the time to work on this counteroffensive, to gain some additional territory. And then maybe there could be a negotiated settlement after that. But I think people are really trying to also think about, could this be lasting longer? And what does that look like for U.S. engagement? We do have a presidential election. There could be a change in leadership. And so they think there's also concern about what that might mean for the future as well. But there's a lot of undecideds. And I think probably the biggest consensus is that we may not see a complete victory, and we're looking for some sort of negotiated settlement.
Jeanette Lowe, a strategist. Jeanette, thank you. Thanks for your input this morning on the latest with the president, foreign policy, and the recent visit to Lithuania. Just got a message on the Bloomberg, Tom. Bull market and victory laps. Bull market and victory laps.
It's a huge debate. I mean, I'm looking at the screen this morning, and I go back to what Englander said yesterday. It was game-changing. Everyone's going to reset over the weekend. Can you imagine somebody set lower with a more cautious view, the meetings being taken in the next 48 hours to reset for the end of July?
Okay. I just think you say victory lap, and you're setting yourself up for some real humble pie later on in the year, because we're not there yet. And the reality is, I keep going back to what Tony Dwyer had to say, which is it's fine to have those profit margins expand, but then when the revenue declines, all bets are off. And so
that's the heart of the matter.
That's the heart of the matter. If you start to see weakening in the labor market, if people can't keep spending endlessly on airline tickets, just, from a personal perspective, then at that point, you have to imagine all of a sudden it changes the game.
Okay, but if we get inflation down to 2.5%, 3%, which everybody would state is a massive societal victory lap, that still clocks in with nominal GDP.
You want to be up on.
We're not back to 1.8%. But if you get inflation to a meaningful, sticky point, the bet is from the optimists that you sustain a semblance of the revenue growth that we saw from Pepsi.
There's got to be some accountability on these calls, though, TK. You can't just make a call, then wait long enough and say they were right, congratulations.
That's the shell game. That's the Wall Street game.
Well, no, I just don't want to play that game.
When can we play history lesson, though? When can we look back and say the victory lap? It was a winning victory.
I don't know. But this is fun, though, guys.
Is it?
Yeah, another 90 minutes of it. Can't wait. Chanel Desai, Franklin Templeton.
92.
Up next.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona
to the kabaddi tournaments in India
to the cornhole boards at your local tailgate. This is what's next in sports.
Of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority.
Equities up again this morning on the S&P 500 by 0.3%. Three-day winning streak could well become 4. That's what we've got our eye on following earnings this morning from Delta. Better than expected. A raise to the outlook from PepsiCo. Same thing. Bramo's going to give you some detail on that in just a moment. So equities doing okay. Another lift on the NASDAQ 100 futures there, up by 0.6%. The bond market, what a roller coaster, what a ride over the last week. Just kind of nuts. The 1 week range on a 2-year, worthy of a 1 year range on a 2-year. At the high last week, 511 following ADP, and this morning, the 2-year, 466.82 on the screen. Right now, Tom, down about 8 basis points.
Bond market's worth looking at, and this is a point. I usually think we underestimate single-point analysis, 2-year yield, 10-year yield, and that. But right now, the spread market's interesting. John, we haven't addressed this yet. Massive disinversion from a negative 111 basis points down to a less inverted yield curve, negative 85 basis points. Now, I don't think anybody's gaming that to go further. It's not a victory lap for the bond market, but clearly you have to say, boy, have we come a long way in terms of disinverting.
In just a week, led by a 2-year yield absolutely nosediving. Off the back of that, the dollar's backed away. Weaker. Just breathing some life into that trade again over the last 24 hours. The euro stronger for a 6th consecutive session against the US dollar. 111.72, just off session highs. We're firmer there, Lisa, by 0.4%.
Let's take a look at some of those names you were talking about earlier, because these are stories that really highlight the strength under the hood of all of the equity gains that we've seen. Pepsi shares up 2.4% after saying that organic revenue will probably go 10% this year after a 13% gain last quarter. Across the board, Mountain Dew, Gatorade, Fritos, Lay's, pick your guilty pleasure. They've all been gaining tremendously. And this really speaks to Tom Keen's love of all sorts of Cheez-Its and things like that, but also just the ongoing ability to pass along price increases. Delta, probably even more interesting. And John, you pointed to this earlier. The chief executive officer, Ed Bastian, saying in an interview with Bloomberg, there is significant growth ahead. Flying is the #1 priority for discretionary spending. Not just that, but that also is paired with this idea that oil prices are coming in and people are accepting less service, less accommodations, less legroom, less baggage, less snacks, and continuing to fly.
He's saying prices up, service down.
Pretty much across the board.
Yeah.
And that's what you're continuing to see. And so those profit margins just keep expanding.
Personal stock group.
Do you not get on with flight attendants? They're very nice to me.
Oh, I always get on with flight attendants.
Good.
I'm not one of those people. I mean, honestly, I flew another airline, and there was this announcement saying, please report any inappropriate behavior. I don't.
What was the inappropriate behavior?
Well, I just think that they're getting ready. They've reduced the amount.
Bracing for it.
We're reducing the amount of alcohol they serve before flights in certain areas because it's an uncomfortable
you keep going back to the lack of alcohol on planes.
It's just, I think that there were a lot of unruly passengers in the immediate aftermath of the pandemic. Let's move on.
What is it about the airport that people go, it doesn't matter what time it is, 6, 7 a.m., normal rules don't apply.
Exactly.
And they just start drinking. What is that about at the airport?
Do you want my
No,
psychological
please, I'd love your
analysis?
take on it. Absolutely.
There is an underlying level of anxiety and discomfort
Okay.
associated with travel, and people try to offset that with some sort of palliative measures.
Okay.
That's my take.
Interesting.
I think the dangers are so substantial they should solve it this weekend. The FAA has
What,
to
no drinking
They
in
should.
the air? What about before you
If you
depart?
screw up at 25, whatever the feet is, 60,000.
No, we don't mean
I'm not
pilots
talking
and
the
flight
pilots.
No,
we mean
I'm talking about the
customers.
passengers.
Because I went to a United Airlines lounge once
Yeah.
and saw this guy at the bar with a bow tie on, pre-12 o'clock.
Really?
Before 12. Before 12. Just sort of lining them up for us.
Well, let's just put it this way. Especially when you travel, you are reminded that it is 5 p.m. somewhere at all times. I will just...
On the way to Jackson Hole last year,
It's
honestly.
the opposite. It's earlier there.
Get to Denver. It's like, you know,
Pounding them.
honestly.
Well,
Good.
just one other name that I want to mention, Disney. When Bob Iger was brought into Disney last November, he was charged with finding a new replacement. He was given a contract through 2024.
He is the replacement.
He is a replacement. He found a replacement. It's Bob Iger who's going to be there through 2026, and their shares are higher.
We have this jewel in Los Angeles, is a completely nuts reporter, Lucas Shaw, who is just brilliant on the egos of Hollywood. And he said, Iger has no other thing to do but find a successor. Nothing. You know, Dumbo doesn't matter. Pinocchio doesn't matter.
But
Just
at
get a
some point,
successor.
Tom, you are the successor.
He is. Oh, you know, you're
Particularly when
absolutely
you're
right.
gonna
This is
spend an extra
ridiculous.
Exactly.
2 years.
This is
And
ridiculous.
Clearly,
Lucas made clear of that.
clearly he knows, and I don't know this for sure, but I imagine that based on the decisions of the individual before him, Chapek, that some of that is
Right.
coming to light now. And I'm sure that if you're in that seat, you don't want to be seen as responsible for that. So you want to make some of your own changes.
I don't know. Do they have the Barbie franchise? I don't even know who is the Barbie movie getting all the buzz.
It's Mattel.
Is that Mattel? No, but they're not a movie. Are they making it with Disney? I don't even know. But Lucas says it's going to be huge. He says it's the surprise of the summer. It's going to be
The Barbie movie.
the Barbie movie.
Okay.
You going to see it?
Back
Cool.
to that.
No, I haven't seen it. I keep telling you where I'm going to
You're
watch
watching Mission
Impossible
Impossible.
on.
I get it. Kennel
On
Fever
Saturday.
wants to go to Barbie.
Yeah.
You may go.
Warner Brothers, I'm told, is Barbie, Tom.
Yeah. Look at this. Here's a headline. Chart Banner's got this just out. Delta's fleet of A220s to grow to 131 aircraft. Do they have a Guy Johnson would say they don't have the time to make the airplanes. You know,
Can't get them quick
literally,
enough.
They can't make them quick enough. I mean,
Yeah.
that's the boom economy we're in, and that's pushing against the gloom. Joining us now, Sunil Desai, CIO of Fixed Income at Franklin Templeton. Sunil, I rarely do this, but I really want to focus, and really it's a legacy of John Templeton, which is you have to get out 1 year, 3 year, 5 year. The Franklin Income Fund, what Ed Perks has done there, he's been with you forever, is to me an almost act of God in terms of a Sharpe ratio. His industry category is negative, pretty moldy statistics, and yet you have delivered solid fixed income returns against the toughest bond market in my lifetime. How did Ed Perks, how did Franklin Templeton do that?
It's Ed Perks. Ed Perks and his team are amazing. And yes, they're absolutely living up to the Franklin and the Templeton up to our cultural background, I'd say. And absolutely being very active, being very careful to adjust duration in a careful way, picking individual pieces, and I think that's how you do it.
Chanel, what's so important here is in the equity markets to win by 200 basis points, 300 basis points, a big deal. You guys are beating the bond disaster by 500, 600, 700 basis points. Now what? What's the next step for something blended like the Franklin Income Fund?
I think there's a lot up ahead. Ed is, and I want to be very careful and very clear here. Ed Perks runs his group very independently from the fixed income team. And I would say that looking at what our call is in terms of duration, et cetera, we are looking going forward as there being a time when duration will become interesting. There is no doubt. Right now, in the fixed income group, we continue to be relatively neutral. I don't want to speak for the income group, which actually works separately.
Sonal, you still believe that we're going to see a sell-off in bonds, particularly at the long end. Do you hold that conviction even after what we saw yesterday with CPI and the expectations that we'll see some sort of reiteration of that disinflation today with PPI?
Oh, I think we're going to see the disinflation. Nobody expected disinflation never to happen. So I would simply note a couple of things. I was listening to you talk about the victory laps earlier today, and absolutely, this was an unambiguously positive number. That is good news. Having said that, I would point to three different factors. Atlanta wage indicator increasing at 6%. That's wages increasing at 6% right now. Looking at the rally that you've been talking about in equity markets, we have essentially unwound financial conditions to about 400 basis points ago. That is when the Fed started raising rates. Look, I get it. There's going to be, a lot is not captured in financial conditions, but that rally does continue to counteract what the Fed has been doing by raising rates. And finally, nobody's talking very much about it, but fiscal policy is rather loose, and it remains loose for the next several years right now at current points. Not expecting a massive pickup in inflation, but I think it's way too early to be calling victory laps, especially on core. I think it's going to be sticky, and it's going to be sticky for longer. The other piece I would say is that it is interesting looking out further into 3 years, 4 years, 5 years down, because absolutely, I think Fed neutral rate, which is still stuck at 2.5%, that thing is going to inch up. It needs to go up because 2.5% doesn't make sense.
Sonal, how much conviction do you have then to really trade against the sea change that we're seeing expressed in markets where people are pricing out further rate hikes after this month?
Well, no, so rate hikes after this month are up in the air, absolutely. I think what's really wrong, though, is assuming you're going to get rate cuts as the other side of that. You're not going to get rate cuts. While this year's rate cuts are largely in the process of being priced out, I think probably there's an assumption that you're going to get too many rate cuts next year still. So, will the Fed do another one and then pause? Likely. Do I think it's a straight line from 3% down? Actually, unlikely, even on the headline, because we are going to see the peak impact of base effects over the next few months. And also, I think we end the year with core inflation continuing to be pretty much twice what the Fed's target would be, and twice maybe as much as 4% plus on core. So yeah, headline will come down, but I don't think that core is coming down quite as quickly.
Interesting. Sonal, wonderful coverage as always. Sonal Desai of Franklin Templeton. Mike McKee went through those base effects yesterday and how they develop as we go through the summer and beyond. Lisa Apollo, Torsten Slok, up in about 50 minutes. He's talked about those long and variable lags over the next 12 to 18 months and pushing back against the hopes and dreams of a soft landing in America.
What I'm curious from him is what is he looking at in terms of labor market softening? That's what some people talk about as sort of a key indicator of what's to come. What's the time frame and how he interprets the base effects versus the true disinflation that we're seeing right now.
And when that tightening effort, Tom, begins to hit the economy.
Well, it hits the economy, and I'm glad you mentioned it, John, because we're talking all markets today. But the economy, and there's still maybe not a recession call out there, but a slowdown call.
Sure.
And let's not forget that. I mean, you can talk about the financial end of this, but then there's the GDP end of it. With that said, you look at the optimists out there that don't get enough cred right now. And what if we get another 2% GDP, 2 and 2?
We'll give them a victory lap.
Well, no one's modeling that.
They can, Pramo. We'll give them that. We'll give them that.
No one's modeling. I'm serious. No one's modeling.
We know you're serious.
GDP.
It's okay. Don't worry. I'm not, just wind you up a
Where's
little bit.
Europe right now? Flat?
Europe, today?
Yeah. Flat?
Like on the day?
No.
Oh, some parts of Europe have done really,
Germany's
growth.
like really difficult.
Growth, yeah, no, recession.
Yeah.
And China, the numbers overnight, again, not stellar.
But most people in the financial media and the political media will say that there's no American exceptionalism. We're flat on our back. And the answer is no, we're not. Delta's minting money.
Yeah, PepsiCo too.
That's,
sure.
I'm sorry.
If you are just tuning into the program, welcome. The S&P 500 positive 0.3%. As I mentioned, Torsten Slok of Apollo coming up at 8:30 Eastern Time. Don't miss that. Andrew Hollenhorst of Citi, just building on the work from yesterday, publishing moments ago. 25 basis point July rate hike remains likely. We've been expecting a subsequent hike in September, but Recent data raised the probability it's delayed to November. So they may be pushing this out a little bit, not just yet, but starting to flirt with that idea. Upcoming data may not look so sanguine. That's their view. Wage growth and how it starts to bleed into overall inflation in months to come.
Non-farm payrolls come down under 200,000, maybe, you know. I mean, there's a lot of people. David Kelly's been leading on that at J.P. Morgan. You get that ebb, but, you know, so we got the July meeting and then there's a September meeting. Is that the new hawkish pause?
Jackson Hole's going to be a great forum, Tom. Platform's there if they want to communicate.
To me, it's a bigger mystery than last year, frankly. Hopefully, you'll speak for 1 minute more.
What, we get 9 minutes?
9 minutes.
9 minutes. We're going to be there, right? Late August.
We're going to be there. A lot of planning
Very
going
cool.
into it. A great group of people scheduled to be there with the Kansas City Fed.
Nice. Who's the Kansas City Fed president now?
I don't think they have one yet.
They're going to sort that out for Jackson Hole.
No, but there's their baby puppy to Pivot, and Pivot will still be
Esther
there.
George was always so welcoming.
She was lovely.
She's wonderful. What happened? What happened, Tom?
So let's go inside the boardroom. Let's suppose you win a proxy fight and or you just get invited onto the board. You go to your first board meeting and you're the person who's saying you can fix this company and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with the plan.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
They won't move at the meeting after July. They'll take a break just like they did this last time. And then we're going to get to November 1st. Well, there's a long time between now and November 1st. I can imagine by that point, it's possible that they'll see enough news that makes them confident that they've done enough. So I think the November rate hike is really up for grabs at this point.
We're already talking about November. It is July 13th. Bill Dudley, former New York Fed president, Bloomberg opinion columnist. That's the argument right now. A lot of people starting to say one and done for the Federal Reserve, one more hike this month, then they might be done. I think other people pushing back over the last 24 hours to suggest that even if they are done in September, maybe they have to go again in November because the base effects, Lisa, start to kick in a different way.
And all of a sudden you could see a re-inflation. There's also a discussion I haven't heard enough of, which is if this is one and done for the Fed, a longer period of rates at this level, could that end up being more harmful, more restrictive to the economy than many people are factoring? Maybe not later this year, but certainly early next year.
But certainly you listen to stories and how they're told about why we need higher interest rates. The inflation data yesterday has changed those stories in a material way, Tom. And Steve Englander, you've quoted him all morning over at Standard Chartered. He called it a game changer. There was a lot to like about that inflation print.
Well, it's a game changer, and you see it in the depth of the market, the foreign exchange market as well. I would just suggest that what's so important to me here is just the optimists having their day and the rationalization that's going on in spades this morning, getting to earnings season starting tomorrow. The industry's rationalization meter right now is pegging hard right.
Yeah, the Fed's going to be very focused on month-over-month core inflation, Tom, and There was a lot to like yesterday. Will there be a lot to like next month, the month after that, and the month after that?
By definition, they'll be ex post. And the question is how much ex post is a really important question, John. Is it out to September or does it even go out further than that? What do we got from Steve Englander here?
This is a quote from Steve. Do you want the quote now?
Please.
I can get to the quote from Steve on CPI. Likely to be a game changer. Goes on to say, we doubt that the Fed will hike again after the July 26th meeting. This is the one and done camp with Steve Englander. This reduces the risk of being long carry and high beta currencies. Nemit Sasak can translate that for you in a moment, Tom. By reducing the fear of being blindsided by an upward shift in the terminal Fed policy rate. It's just taking away that uncertainty just a little bit going through summer.
Just a little bit. And you see it in the market this morning. I would note NASDAQ up 0.7%. Joining us right now to sort this out, and particularly within the depth of the most important market, foreign exchange, Damian Sassower, Chief Emerging Markets Credit Strategist for Bloomberg Intelligence. This is an historic moment, Damian. I can say with all my thinking, Mexican peso crisis, never at 21 peso did I ever think Mexico could launch and breach through 17 to a 16 handle on peso. To me, it's borderline 30, 40 years historic. Why is this happening? Why is peso and other EM on fire?
Well, a lot of people would have you believe with respect to Mexico that it's the whole theme of nearshoring, right? Taking the place of China, bringing it all back. It's so much more. It's actually two things in my mind. It's politics and it's remittances. Remittances from the U.S. to Mexico, from the diaspora, 27% in 2021, 13% last year. It accounts for 4 to 5% of Mexican GDP now. Remittances are a big deal for Mexico, but more importantly, the political scene. Andrés Manuel López Obrador has been a bastion of 50+% approval ratings in an environment across LATAM where your leaders are running 20 to 40% approval ratings, right? What that means is that the election coming up next year, Claudia Sheinbaum, female, Jewish, mayor of Mexico City, Morena, she's probably going to slide right into that seat. There's going to be continuity in Mexico, which is something you don't see in many emerging markets. So what do we have? We have dollar mex up, 20% year to date, 50% since 2021, and crazy numbers. So when Steve Englander gets out and starts talking about the EM carry trade, I kind of just want to fade that a little bit because we've seen some real big gains already. I get what he's saying. The path for dollar weakness is there, but if you bet against the dollar in EM, you're probably not going to last.
Is there a bet on the street that DXY goes through and goes goes weaker dollar forward?
Well, I think, Troy Gajewski hit on it a little bit earlier. We expected, I think the market expected to see some speed bumps due to the replenishment of the TGA. And now you're not seeing that the general account here in the U.S. Basically, that would be dollar strong, bullish for the dollar. If you saw some, liquidity pockets of illiquidity in the U.S., you're not seeing that. There's no, that risk has gone out the door. And this is the second largest rebuild of the Fed's reserves, pretty much on record, and yet the market's not reacting to it anymore. The reserve repo facility is acting as it should. I guess dollar bears are, flexing their muscles here off the back of that. And, I get it.
Do you think that it has staying power based on the fact that you just said you'd fade some of the gains we've seen in EM?
Well, here's the thing. I do think it has staying power, but it's so tough to say. The amount of stimulus that was injected into the economy, we don't know when it's going to break. We don't know where it's going to break. But eventually, when you start tightening conditions, things get tough for a lot of different pockets of the market. And so, I remain sort of skeptical. Does that mean I go head first into the EM carry trade? No, but certainly, I can see some currencies out there. Let's think about the EM currencies which are rallying today. It's not the Brazils, the Colombias, the Mexicos, the high yielders. It's the South Koreas, the Malaysias, the low yielders, the Taiwan dollars. Those are historically funding currencies. So if you're long the EM carry trade and you're funding in those currencies, you're probably losing money today. Well, not losing money, but it's kind of a wash. So, it really is about your choice of funding currency. And the Japanese yen right now, which is the one that basically everyone's kind of pointing to as, remaining weak. You could probably see some cracks in that as well. And, I'm not going to go into why, but, look, yield curve control in Japan and, it could definitely go the other way.
We were talking with Alan Ruskin earlier about the weak dollar call, and he sees euro really gaining supremacy. Yeah. There is a question, though, about the growth differentials, and at what point the growth and the resilience in the U.S. attracts a certain degree of investment. How does that pair with the developing world, which is already facing the lag effects and is seeing a lot of potential slowdowns?
So what I'm looking for, it's a great question. What I'm looking for is negative feedback loops. So I'll give you an example, Sweden, right? And this is JP Morgan speaking, not me, but it's so true. They basically raised rates to bring down growth. What that's done is it's taken down the currency, the Stokey, and what that's done is it's kept inflation artificially high, forcing the central bank to continue to raise rates even more than it can to stoke off inflation, right? So which other countries kind of fall into that camp? Because that negative feedback loop is very, very difficult to break. So I look at South Korea, some others, but that is an area of the market that I just don't think a lot of people are focused on.
But people today, and I don't mean to take a long-term JP Morgan view on what's going on in the Nordic states, but if we have an Englander game changer now, is it where every strategy team has to rip up the script just to get to Monday? Are they going to reset for the end of July?
Only if they want to sell their script, right, Tom? I mean, look, fake news, all that kind of stuff. I mean, look, I don't see a lot of people kind of at mid-year kind of, 180ing their calls. I still think there's going to be risk of inflation remaining sticky and high. I think, you probably might not see the Fed cuts materialize as you otherwise would. Going back to Mexico, we're not expecting, them to get inflation to 3%, which is their target, until the end of 2024. So you can see rates high, sticky for far longer than the markets are pricing in right now.
When does Messi get here?
He's here.
He's here. He's
arrived. I think the
arrived.
jet arrived. Yeah, at Fort Lauderdale Executive Airport. And I track Messi, of course.
Evidently.
Have you managed to get some tickets?
When we got to get? How much tickets are going for it?
I know.
Here playing Red Bull, it was $40 before he joined into Miami. Tickets for that game are now $500-600. Crazy.
That's ridiculous.
He is. What is the deal? $150 million for 2 years. And that's not including Adidas or Apple.
Adidas.
That's
the
crazy.
Adidas.
It's awesome. He's the best. I can't wait.
It's going to be awesome.
What's he like on the field with MLS-type players versus Spanish players or Premier League players?
If he came 5 years ago,
He'd crush them.
would have been pretty embarrassing on a weekly basis. He's slowed down a bit. He's slowed down
He's slowed down, but has MLS gotten better?
It's improving, Damien. Can we say that?
Well, Jonathan, isn't he bringing over a couple of his mates from Barca?
Yeah.
Yeah. So,
Yeah.
Come on, we have
It's
some
like
homegrown
like a reunion, right?
Yeah, it's going to be fun. It's
What
going
do
to be
I
great
want to watch
see.
at Wimbledon this weekend?
Alcaraz is so good, huh?
Oh, he's
20 years old.
awesome.
It's awesome, man.
Oh,
Awesome.
20 years old. It's nuts. Number one in the world.
Yeah.
It's just awesome. Awesome to see.
I'm so excited. I hope he can do it. A Joker won, right? So, yeah, and...
It's going to be some interesting semifinals tomorrow.
Is heat a story with 3 out of 5 sets? Is temperatures, the weather bad there now?
Is the weather bad in England?
Yeah, is it hot?
It's often bad in England.
Well, did you see the grass? The grass is actually looking a little brown there.
Yeah, I noticed it.
Bad weather.
We just live for that bad weather, Ramo.
Exactly.
We live
I'm just
for that.
seguing here into tennis on when we're doing it.
Sinner Djokovic tomorrow and Alcaraz, Danny Medvedev. So look out for that. Men's semi-finals. Women's semi-finals a little bit later. From New York City, Damien, thank you. This was great. Let's do more on Messi in the next couple of weeks. That'll be cool.
Welcome back to another special Wimbledon update from Bloomberg TV and radio from Tennis Channel. I'm Johnny Ray Diaz. The last American man standing in London is out. Chris Eubank's dream run at the All-England club came to an end in a 5-set loss to former U.S. Open champ Daniil Medvedev. 28 aces and 52 winners for the third seed in the victory, while 55 unforced errors told the story of the match for Eubanks. And don't forget, you can watch all the action daily at 5 p.m. Eastern on Tennis Channel.
From the world of politics
We're not going to be relying upon countries whose values we don't share.
to the world of business.
It's all about corporate power at the end.
Balance of Power, live from Bloomberg's Washington headquarters.
We're going to be more excited what's in store for you.
How long will it take? How many years? Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join host Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee
The
Lines.
door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
That
it.
really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case that
and it's now more than well alive.
That's for sure, with 2 more potentially to come. I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers
Right.
that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on and folks are so excited about it. Climate tech is the hottest area to be in.
For the first, call it 18 years at Chipotle, this was you come into Chipotle along the line, you interact with the crew, and you customize your meal. We've got this separate make line, and it's digitized, and so the orders come in, and they're really kind of staged so that if you say at noon, I want to come in at 1 o'clock, we hold that order, and we will send it to the crew like maybe 10 to 1,
Right.
so it's ready right when you pull up your car.
How do you manage these kind of 2 different staffing needs, right?
Yes.
And making sure you have the right amount of people
Yes.
at the right time.
We spend a lot of time projecting sales. A lot of it is, it's part art, part science. We're trying to bring more science and more AI into it. Because if you get the right sales projection, then you know exactly what your staffing needs to be. So if you get the sales right, you can get the entire restaurant staffed perfectly. With just a couple people, our average restaurant now does about over $1 million per restaurant in digital sales.
Business Week Radio, live weekday afternoons at 3 p.m. Eastern.
We got a little bit of talking.
Come on, are you guys ready?
Harnessing the power of Bloomberg Business Week, Carol Masser and Tim Stanovic bring you the latest news from the worlds of business, technology, politics, and more.
How does the Fed play into this and what the Fed does potentially?
This is so exhausting and this is so all-encompassing.
Listen on Bloomberg Radio and streaming on YouTube and Bloomberg Originals.
I do think that the lagged effects of policy are finally catching up and that we are going to go to a sub 1% growth rate.
The economy is in pretty good shape, even though growth is slow, but inflation has been coming down.
The frustration here is seeing the Federal Reserve still tighten to fight a battle they've already won.
They won't move at the meeting after July. They'll take a break just like they did this last time.
They may be reluctant to cut until they see more evidence that the labor market is imbalanced.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. Game changer Thursday. Air stealing from Stephen Englander, Standard Charter. Something in the air changed yesterday. And John, for the Fed, for financial participants, it was disinflation.
Yeah, forget July. They're going to hike. Most people assume they will. It's after that. Perhaps they're done. That's the view from a lot of people this morning. Others, the likes of Citi, thinks that perhaps you'll get another one in November. But ultimately, there was a lot to like about the data yesterday, showing some disinflation in America. Can that continue? A couple of questions we've got about the earnings right now, Tom. Delta, fantastic, beat and a raise. Discretionary spending, a dominant story there. It's pretty decent. Unemployment's at 3.5%. Inflation's moving in the right direction. Is that yesterday's story, TK, or can that persist through the rest of 2023?
Well, we're going to find out here in a moment. Our conversation of the day, Ed Yardeni to be with us here in moments. And John, the wraparound here from the Yardeni Ancampora low in October is, what do you do if you're in the triple leveraged all cash fund? What do you do if you're a bear? What do you do if you're short right now?
If you missed 40% and that move on the NASDAQ.
Or just blended. Let's say it's 18%. You missed 18%, whatever, yeah.
Then you missed out. You're wondering if you should get in. Lisa, can you sit this out any longer?
That will be the key issue, especially for institutions that have cash allocations that they could potentially start to funnel into equities. Key issue for me, and I'm very curious to hear what Ed Yardeni has to say about this, is profit margins. We're about 30 minutes away from PPI. The differential between the prices that some of these companies can charge and their their costs, which have gone down, has allowed them to enjoy expanding profit margins. When does that shift? When does that reverse? And what's the response?
Let's drive it forward to Friday, the beginning of the large bank earnings seasons. How have the big banks adapted? To me, it's all about corporations adapting. It's a financial media with a static analysis where corporations are working in a dynamic environment. To me, the big banks are going to adapt. And once again, they're going to be embarrassed, John, at their profits. They're going to hide how much money they're making.
Tomorrow's about credit quality. If you go through a lot of the analyst notes, looking ahead to JP Morgan, to Citi, to Wells, credit quality, loan losses, loan loss reserves. They've been guiding, and most people have been guiding to pretty low expectations around that, Tom, across a number of these banks, particularly on the trading side of the business as well. So the bar's been set pretty low going into the financials tomorrow, and we'll see how they deliver.
And the data, John, I'm just going to go to the real yield, which is stunning. We were at 1.80% on the 10-year, 5-year real yield, way out over the last number of days. That fear of a rising inflation, 10-year yield from a 1.80 back to 1.55. That's disinflation.
That's the bond market. Let's get to equities, gearing up potentially for a fourth consecutive day of gains on the S&P 500. Equities up here by 0.4%. In the FX market, 6 days of this now, 6 days of euro strength and dollar weakness. Euro dollar, 111.79. Tom, we're pushing 112, that currency pair positive by almost 0.5%.
The hallmark of the show has always been to keep score. We take careful care with those that get it wrong. We really pay attention to those that get it right. It is no surprise to anyone over the decades to know with a longer time frame, a longer perspective, the gentleman from Yale once again has nailed it. Edward Yardeni joins us, president of Yardeni Research. What were you thinking, not the third week of October, the low, but let me say the first week of October, the hysteria there, the gloom. How are you framing out the optimism that got this really going?
I watch sentiment in the equity market very carefully, and there's something called the Investors Intelligence Bull-Bear Ratio. And in mid-October, it got down to 0.60, which is as depressed as it was in March of 2009. And I was thinking, surely things aren't anywhere near as bad as they were back then. And I've also been of the view that we're not going to have a economy-wide recession. I was of the view that we've been in a rolling recession. So it all kind of came together for me by the end of October, and I said, I think October 12th was the low.
Do you think we can carry on beating up low expectations?
Well, the problem now is that there's too many bulls. We've nothing to fear but fearless investors. We don't really have enough the technical sentiment picture isn't that good because there just aren't enough pessimists out there. But the problem is the fundamentals are really good. I think everybody's swung around from worrying about an economy-wide recession to sort of embracing a disinflationary soft landing. And, we'll see what happens with the PPI, but, we could have a trifecta of really great numbers. Expected inflation on Monday was lower than expected, and the CPI was great, and I think the PPI is going to be very good as well. So disinflation is here.
Will bank earnings validate some of the optimism?
I think so. I think we are going to see a continuation, as you pointed out, of an increase in loan loss reserves. The Fed actually puts out a weekly series on that for large banks and small banks. For the large banks, it's actually up 16% on a year-over-year basis. So there could be some disappointment on earnings from that perspective. But much depends on the economy. If people embrace the view that the economy can continue to grow, then credit quality is not going to be that big an issue. And they may be able to, within a few quarters, just to reduce those loan loss reserves, and suddenly the profits are looking pretty good again.
Months ago, you were talking about 4,500. How high have you gone in terms of an S&P forecast?
Yeah, I've actually been, I'm going to raise you by 100. I've been talking about 4,600.
Okay.
But what's the difference? It's been a bull market since October 12th. And the problem with 4,600 is we're awfully close to that. That was my year-end target. And it looked delusional earlier this year, I have to admit. But it's worked out awfully well. We're only, 150 points away from that, maybe less than that. So let's get to 4,600 and then ask me again. But I'll probably raise it to 4,800, depending on how things are shaping up.
How do profit margins fit into this? Because we were speaking earlier about the likelihood where we could see a shifting narrative there, especially if revenues come in the way that Tony Dwyer was talking about. Do you see things differently?
Well, we have had a earnings recession, a very mild one. It looks like earnings are going to be down about 8% on a year-over-year basis during the second quarter, and that should be the worst of it. And then we start to progressively see better comparisons and a positive comparison by the fourth quarter. Interestingly, this earnings recession hasn't been attributable to revenues. Revenues for S&P 500 are at an all-time record high, so clearly it's been the profit margin. So the profit margin has been getting squeezed for the past year or so. But I see signs in weekly data that we monitor, looking at forward earnings and forward revenues that suggest that analysts are seeing signs that that profit margins are bottoming.
I look at your, Denny, at the past here, and it's so easy to go back and do some analog with 10 years ago or 40 years ago. The fact is, when we first knew Denny at C.J. Lawrence, you were with Lou Rukeyser talking about the public in individual stocks. Now we are overwhelmed with index fund investment and ETF investment. How does that change the dynamics of the market, optimistically or negatively, given these new instruments?
Well, it's very frustrating for individual investors and certainly for institutional investors that we're taught that diversification is an important aspect of managing a portfolio. And suddenly we have the mega cap 8 stocks that account for 27% of the S&P 500. So, if you don't have 27% of your portfolio in those stocks, you've been underperforming. So it's a lot of pressure to play that game to continue to buy into that group of stocks, but it is what it is. These are great companies, and they're. I think it all really started, with when Facebook realized that their stock was getting hammered. They said, "Well, we can show everybody just how much we really make. All we got to do is cut our expenses, and that's easy enough." And that's what a lot of them did. And then the AI thing
So what's the theme forward? 12 months forward, what's the next theme for corporate America to perform?
Well, my theme is, I tend to focus on longer-term themes. My theme is the roaring 2020s, which, again, looked quite delusional over the past few years. But the decade isn't over, and there's still time for it to run. And I think technological innovation is going to make a big difference.
John, the analog there is the pandemic of 1918, 1919, boom, right into the roaring 20s.
You coined the term bond vigilantes.
Yep.
Can you offer us your analysis on the bond market right now, treasuries specifically?
Well, it's interesting how well the bond market's been doing in an environment where the Fed's been raising short-term rates quite aggressively, and in an environment where we have quantitative tightening, where they're actually letting their securities mature. There's clearly been a tremendous demand for bonds. I think a lot of it is there's a tremendous amount of liquidity out there still. I know people have focused on M2 and have had a doomish scenario because M2 has been declining, but M2 is still about $1 trillion above its pre-pandemic trend line. Demand deposits are also something more than that, actually. M2 has never been more liquid.
Is there an obvious relationship at the moment between how treasuries have performed and what equities have been doing?
Yeah.
What is it?
Well, I think, last year they were both doing horribly. It was something that we hadn't seen in quite some time. Now I think both asset classes have done quite well. The bonds have at least earned you the coupon. They haven't really hurt you. I'm looking at the bonds too. I think the bonds peaked at 4.2% on October 24th, I believe, last year. A lot of good things happened in October of last year. And so I think the bonds are okay, and I think stocks still have upside, especially in the laggards like financials and industrials.
So you think even if the Fed sticks at, say, 550 and just holds it there, this equity market's okay?
Well, the Fed's been kind of telling different stories. When individual Fed officials have been talking, they've been awfully hawkish, but when they get together and put together their summary of economic projections, they've been very reasonable. They said, look, we want to get it up to a restrictive level. I think they're there. The banking crisis, I think, demonstrated that they're there. It's restrictive enough. And I think they want to keep it there. I never was in that camp that believed that the Fed was going to lower interest rates. I took them at their word. I think they could declare mission accomplished, except that's the jinx. So it's better that they don't do that and that they continue to talk hawkish.
Can they take a victory lap?
Well, I hope they don't. Victory laps are jinxes,
There you go.
I've had a few of those in my career, only to be wrong almost the next day.
That's our theme this morning, Ed. When you weren't here, they were busting my chops about victory laps.
Well, Ed, we won't call this a victory lap for you, but certainly so far, so good.
No, don't do that.
So far, so good. Ed, it's good to see you.
Thank you.
Thank you, sir. Ed Yardeni of Yardeni Research. From New York City this morning, good morning. Welcome to the program. Equity futures right now positive by 0.4%. Coming up very shortly, 8:30 Eastern Time, about 20 minutes from now, actually. Torsten Slogtom of Apollo. We'll talk to him about that PPI data just around the corner.
It's a really important conversation. Torsten's added huge value add, not only with his time at Deutsche Bank, but, what is it, like 8 o'clock every day he comes out with an insight, a single chart, one idea from the huge compendium of research.
I've loved his research.
Yeah.
The focus at the moment, as we've talked about all week, long and variable lags, Bramo. For Torsten, that's been the focus over the last couple of days.
He was talking about soft landing for a while. Now it's moved to recession as the most likely scenario because of said 12 to 18-month long and variable lags, which he says it will hit the market at some point in the near future.
Would you like me to stick around to talk about airlines?
I would love it.
Oh, that'd be great.
But you don't want
we
to,
can
do
do that.
you?
No, I'm happy to. We can talk about Delta. You want to talk about United and American, and Bramo's going to give us a rant on and Delta Airlines and how she feels. How she feels about transferring in Atlanta.
I saw one of those.
That was a negative.
I saw one of those flight track tweet things, the busiest day since time began.
Yeah.
And they can really count it. It's extraordinary.
I see that every summer. Same thing, isn't it? Airports.
But
terrible.
this is worse, right?
Yeah.
People live blogging the weather. You notice that too? Have you noticed the live blog of the weather?
Yes.
Like everywhere.
I've seen that.
All these media organizations live blogging summer.
Well, and Tom's still watching Jet TV.
Love that. Love that.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month. Our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 12 p.m. on the East Coast, 9 a.m. in the West. Only on Bloomberg Television, your global business authority. Season is coming.
We're going to see cracks start to emerge. This earnings season could be a little bit choppy.
This is going to be an earnings season mystery.
Bloomberg breaks the numbers first.
Those earnings just crossing the wire.
Up by 25%.
Absolutely blew out of the water expectations.
With exclusive expert analysis.
We're starting to see earnings recovery emerge.
AI will be a huge boost of revenue growth.
We're not going to see the same follow through in terms of the price reaction.
Second quarter will be where the rubber meets the road.
Bloomberg Television and Radio. The fastest numbers and analysis you trust.
We're seeing disinflation everywhere. We're really seeing deceleration and disinflation in the U.S. economy. I see plenty of signs that inflation is just fading away here. And the frustration here is seeing the Federal Reserve still tighten to fight a battle they've already won.
David Culley, outspoken there. Global strategist, chief global strategist at JP Morgan Asset Management on the latest inflation data. The Federal Reserve, in the minds of many, set to hike interest rates once again at the end of this month. A little less than 2 weeks from now, 2 weeks yesterday. Equities at the moment up 0.4% on the S&P 500. The earnings so far so good this morning at least. PepsiCo a beat, Delta a beat and a raise. Lisa and I mentioning this quote from Ed Bastian, the CEO, a few times this morning. We can do that again. Speaking to Bloomberg in an interview, there is significant growth ahead. Discretionary spending, Tom, flying, the #1 priority for discretionary spending.
Yeah, this is sort of a Helene Becker thing at Cowen, but the idea, John, here that regular travelers, mere mortals like Lisa Abramowitz, are taking the business class seats up front because they've got this promo, that promo, those miles.
Credit card points.
Yeah, whatever. But there's really interesting dynamics right now.
Fake news.
What we're going to do now is dive into
Real
this.
news. Not in business class. Carry on.
We're going to dive into this with somebody truly expert in this. George Ferguson is at Bloomberg Intelligence. I put him in a category with a giant Kai von Rumer over at Cowen as well, with decades and decades of experience on this. George, I've never asked this question on air, but I think it's on the mind of everyone. We're jammed. We're at capacity. That you sit on the runway, the whole thing. From where you sit, is there an integrity within American aviation where George Ferguson can say it's safe to fly?
I think I can say it's safe to fly. I think it's a well-regulated industry. I think the people in it care a lot about safety. The accident levels have diminished to nothing in the U.S. From a couple of years back in the 80s. I think it is safe to fly.
If there's an algebraic equation, it's got 4, 5, 6, 7 George Ferguson factors in it. Which is the factor that allows for growth, given population growth, given prosperity in America? Is it we need more gates, we need more planes, we need more flight attendants? Which is the factor that matters?
So I think it is we need more pilots. Employees are definitely a problem right now, but I think longer term, the training of pilots, the bringing them into the industry, I think it's a challenge that's going to overhang for a number of years. We have a lot of retirements coming up. So I think the airlines really have to be thinking about that.
We're talking, and John quoted Ed Bastian of Delta saying that the #1 thing people are using the discretionary funds on is flying around the world. And this comes after a 2-year hiatus during the pandemic where people were basically homebound. How long can this you only live once, the YOLO of the consumer, both in America and elsewhere, continue?
Yeah, I mean, that's the big question we all have, right? So when you look at Delta's earnings this morning, quite strong, back to 2019 levels of profitability. You look at what they've guided to in 3Q, looks like a similar quarter. Leisure is really leading this, the recovery here. Business not back yet. I think they're selling some of those business class seats at a bit less than what they were selling them for in 2019. Europe was really, really strong, and this is the summer where everybody went, look, I haven't been to Europe in 3-4 years. I got to get back there, and I'm going to pay whatever it takes to get there. I don't know that we get this next year. I don't know that this leisure bounce persists, especially I don't know if this leisure bounce persists as we get into this, the effect of higher interest rates. If the economy slows, that's a challenge I think we have.
Have these airline companies shored up their balance sheets sufficiently in the case that it doesn't continue, in the case that American travelers look at the cross currents of the dollar and the euro and where the euro is and potentially strengthening versus the dollar and say, we're not going to go to Europe, and they're not going to buy those tickets?
So I don't think they've done it yet, right? But we did see a debt pay down in this last quarter by Delta. They are using their cash to try to get their balance sheets back to square it away, but they're not there yet, but working on it.
We also have seen costs come in quite a bit, led by oil prices down about 24% year over year. They also have created efficiencies in places like snacks and bags and basically space. I'm not going to go there. I'm not a purveyor frequently of the booze offerings on the flight, but I'm curious from your vantage point how much further they can squeeze the consumer before they start pushing back and saying, I need a little more leg room than, a tin box.
Yeah, well, I mean, I think it's already starting, right? So we already saw Fed data come out the other day that showed fares down 8%. So I think consumers are starting to look for lower fares. The domestic yields that we saw from Delta for this earnings season grew by nothing since last year. So on the domestic market, I think the consumer is starting to push back a little bit. And again, if the economy tightens, that will continue. Go ahead, sorry.
George, we booked you only for therapy for Lisa. We're with Dr. George. For those of you just joining us on radio and TV, Dr. George is with us from Bloomberg Intelligence here on Terminal C at Hartsfield.
George, final one from me on international. Do you get the sense that first class is coming to an end?
Yeah, again, we've done some analysis on fares, and first class has done okay. But I think the fares aren't as good as they were when business was traveling more. So I think you're getting, again, a bit of upsell for leisure that isn't quite as good as business. And again, if the economy gets a little softer, that could be harder to do, and I think it will.
George, one final question quickly here. Is Boeing, have they lost their game? Have they lost their step?
They had some pretty nice delivery numbers for the quarter and for the month of June. Look, it's taken them a little bit longer to get their mojo back. They went into the downturn with the MAX, grounded in those difficulties. I think they're still a great company. It's taken a little more time to get back going, though.
John, this is fascinating.
Sure, yeah.
To you, I think it's an Airbus market, but this is all new for America. That Boeing's not on its game.
George, one final. No, I'm joking. George Ferguson of Bloomberg Intelligence. George, we're out of time. It's great to catch up, George. Thank you. On Boeing and on the airlines as well. Do you know what bugs me? Status at airlines. Okay, so bear with me. I don't think you should be able to acquire status through spending money on credit cards. You can acquire points. I don't think you should be able to acquire status. I think you should be able to acquire status primarily.
What's status? What do you mean status?
So you should be certain tiers so you can get access to lounges.
Oh, yeah, access to lounges.
You get priority for boarding.
Right.
That should be acquired through flying.
Right.
BA does this. There's two separate things. You get tier points, you get Avios. You can acquire Avios through spending on credit cards if you want to, flying as well.
Right.
Tier points is for flying and flying exclusively.
And I'm
that
guessing,
goes to status.
Right, which is the reason why the threshold for people when they fly gets higher and higher for getting status.
Precisely.
Because all the people who are coming in through spending on their American Express cards or whatever else, or their Delta or their American Airlines or whatever cards, get it in for free, and then it's crowded, and then you got to wait in line, and people
That's
are
exactly what I'm talking about. There's so many people listening to this right now that know exactly what I'm talking about. The lounges are packed. They're packed. Can't get in.
A leading aviation CEO voiced exactly what you said, John, and he told me this is his single biggest headache.
Delta, we talked about Delta. Go to Delta at JFK.
Haven't, but okay.
There is a line right around the corner. I don't even use these lounges when I travel for work.
I don't either.
I don't even go into them anymore. It's ridiculous.
And then there's like a tiering of the tiered, right? I mean, this is basically, talk about a hierarchical society.
American at
ranked
JFK.
Yeah, I mean, that's essentially what you see. Not only you have first and business and economy, now you've got Comfort Plus, and then you have the people who get priority access to the lounges, and the others have to wait in line.
Here's the reality. Red O'Keefer of the Amex is going to me, why are you having dinner at Fortnum and Mason and Heathrow and not in the BA Lounge? And I said, it's equidistance between the Hermes store and the Burberry store, so I can kill 3 birds with one stone.
And it's at the bottom of the bottom
and
of
it's
the
at the
escalator.
bottom there, and it's really good. Yeah, it's like a British thing. Lisa, it's a British thing. They have tea or tea, whichever it is.
Nice scrambled eggs
Ted
with salmon.
Lasso doesn't eat there.
Nice scrambled eggs with salmon. I'm with you. It's great. Nice
I love
cup
the
of tea.
colour.
Oh, yeah, I'm with you too. It's great. That light green. That's nice.
So the EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
A lot's happening on Wall Street.
There are so many factors at play today.
It remains tight in certain parts of the economy.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Crisis is too strong a word, and words like that get used a lot.
From businesses most influential and instrumental.
America's economy needs a diversity of institutions. That's something that Wall Street pays a lot of attention to.
Bloomberg Wall Street Week, live Friday with replays all weekend on Bloomberg Television and Radio.
Bloomberg Surveillance, Jonathan Farrell, Lisa Bramlett, and Tom Keene. Mr. Farrell's off on a victory lap trying to get to the 9 o'clock hour. Bramo, full disclosure, I have ignored PPI because it used to be a big deal and then it wasn't a big deal, and all of a sudden PP's a new big deal.
I think this is actually going to be really important, especially given what we saw yesterday.
Does it confirm what we saw yesterday?
Does it confirm what we saw yesterday? And then on a more granular basis ahead of earnings, do we see PPI coming in more than CPI? And that really is what remains to be seen.
Let's go to Michael McKee in Victor, Idaho, with unnamed economists catching trout. Michael McKee on PPI. What do you see, Mike?
Well, we're waiting also for jobless claims, but with PPI, we're seeing a better than expected number like we did with CPI yesterday. Final demand month over month, only up 1/10. It was forecast to be up 2/10. The ex-food and energy up 1/10, ex-food and energy and trade, which is kind of what we look at as the core number for PPI, up only 1/10 as well. So on a year-over-year basis, headline PPI is up 2.4%, getting close to that Fed level, and the core 2.6%. So more good news there. There was some thought that we might see a negative print with PPI this time, but not yet. Now, jobless claims come in lower than they have been, which is another surprise. 237,000 after 240. Let me get that number. 249. The week before, so it was raised by only 1,000. So jobless claims continue to show the strength of the labor market. The number of people who are still getting benefits, continuing claims, 1,729,000. That is only slightly up from 1,718,000 the week before. So we're not seeing layoffs in any great to any great extent, and we're not seeing prices rising to any great extent. And that raises the question of soft landing and how many more times the Fed does feel it needs to raise interest rates.
Michael, take a second look at the data. We'll do the markets here as we can. A lift to the markets. The NASDAQ 100 is what I'm watching more than anything, up 0.7% on the tech roulette wheel, 15,552. SPX now up a sprightly 16 points. And critically, the VIX. Will we make a dash for 12? The VIX 13.44, all the way from a 15 level, 48 hours ago. Two-year yield comes in 9 basis points, 4.66%. I really want to make note of the real yield, 1.56%. Brent crude's still above 80. That gives some sprightliness. And the number one thing I would look at is the DXY index. To see DXY break through 100, I think would be extraordinary. Mike McKee, one more observation here very quickly. We got a dash to Torsten Slok. What else do you see, Michael?
Well, the only real news in the PPI is that it was all in services, a 0.2 rise For services, there was no change in goods prices. We had seen the goods versus services turn around a couple of months ago, and goods prices start rising faster, but now they've flattened out again. So it looks like the trajectory is good, and I know you'll talk about this with Torsten, but of course, PPI, not as important, doesn't have a direct relationship with CPI, but overall, the inflation news is good right now.
Michael McKee, thank you so much. Reporting from Victor, Idaho. We bust his chops about it, but this is a wonderful economic conference, precursor to Jackson Hole that has some huge value, great attendance as well, just beginning to think about the theories of the moment and the theories forward. That has been the expertise of Torsten Slok, holding court at Deutsche Bank for years. He's chief economist at a rising Apollo. Torsten, thank you so much for joining this morning. What's the operative theory right now for a Fed? Let's say they're restrictive. Some would say they're super restrictive. Underlying that is a need to turn at some point. What's the theory they have right now to get ready to turn out, quarters out, meetings out?
Well, that's a really good question. And I think the answer to that is it's all about the dual mandate. That for a long, long time, they've been focusing on the inflation part of the dual mandate because it was very clear that inflation was and still is at levels that are too high for their comfort. I do think that the narrative, both for the Fed and also for markets, will now begin to change towards growth or towards employment. In other words, what are the reasons why we're still having this strong economy, and if the lagged effects of monetary policy that they have spoken about for so long, where it takes 12 to 18 months to slow the economy down, well, the lagged effects of Fed hikes will eventually begin to slow things down. We're already seeing that across all indicators, and we should expect that also to happen over the coming quarters.
So then how do you explain jobless claims coming in lower than expected? How do you explain other metrics of wage growth continuing to remain robust?
Yeah, so in that sense, there's still a very strong labor market. Average hourly earnings last Friday went up, and this labor market, obviously in jobless claims, still looking relatively tight, which certainly also get the Fed to say, well, we still need to hike rates more, and still tighter monetary policy is needed.
But at this point, if you see companies, whether it's Delta, whether it's Pepsi, whether it's a number of the others that are seeing profit margins expand with their input prices coming down more than what they can charge consumers, you have people who are employed. At what point does it become a virtuous cycle that offsets any pain of those rate hikes?
Well, and also at this point, as you also talk a lot about, the housing market is beginning to recover. Traffic of prospective buyers is going up. You look, existing home sales is going up. New home sales is going up. Home builder confidence, home buyer confidence. Even the number of offers received per sold property is also going up. Their bidding wars are coming back. And remember, housing makes up 40% of the CPI. So the risk is if we start with core CPI, which was at 4.8, that's still just way too high for their comfort. So that's why for them, it's still the hawkish communication saying both on the inflation side and on the growth side, on the employment side of the dual mandate, we just gotta keep making sure that we don't have an economy that continues to look overheated on a number of different fronts.
I want to look at the larger optimist standpoint that America's fully employed. This was in the zeitgeist off the jobs report 5, 6, 8 days ago. And this is the employment as compared to population ratio of prime age people in America. It is a full recovery mode, literally back on regression, back on trend. That's got to be the most optimistic chart for politicians in America.
Well, and that's why the debate for the Fed is probably, well, do we need to soften the labor market? As you know, different FOMC members are putting different weight on this. Do we need to soften the labor market to get inflation to come down? I mean, let's not forget, inflation today, core CPI, was at 4.8. We are nowhere near the 2% target where they want it to be. And with that backdrop, of course, they will continue to say, we just got to keep going because we still have way too high inflation.
One less understood aspect of Fed policy is not just what happens when you raise rates at the pace they have, but what happens when you hold them for a prolonged period of time, especially as companies have already refinanced and aren't really capturing a lot of the higher yields that are being charged out there by investors. When does that bite? When does that scenario change?
Yeah, no, the very important answer to that is that this is exactly the crystallization of the transmission mechanism of monetary policy. Where is it showing up? And the answer to your question, Lisa, it's showing up in a number of different places. You are beginning to see delinquency rates for auto loans going up. Delinquency rates for credit cards are going up. You're beginning to see default rates for corporates on high yield going up. Loans also see default rates going up. So across the board, both for consumers and for corporates, the conclusion is a default cycle has started. So it is biting. is just not showing up at the macro level quite yet. But it's very clear that the effects of monetary policy are showing up in the background, and it will eventually begin to slow things down.
Lisa, this employment to population prime age, this is the core of America. The success of a decade, 2010, off of the terrible financial crisis, moving from 75% employed up to 80% employed. Granted, there's a lot of people not in that number that aren't employed. A pandemic that was worse than the financial crisis. We've rebounded back and we burst through where we were in the autumn of 2019. It's a fully employed America of the people that are employable.
Well, and this becomes sort of the question, what could change that scenario, which is why we're wondering about transmission mechanism. If you don't see that, you're saying we do see a default cycle that is starting. However, at the same time, some of these companies were sort of destined to default a while back and are now just sort of being washed out. What do you see this cycle looking like eventually? When do you start to see some of those lag effects taking effect?
Well, one way to do that is on my Bloomberg screen to type SHOK and try to give a shock to the Fed funds rate 5 percentage points higher. What is the profile for GDP over the next several years if you do raise the Fed funds rate by 5 percentage points in a very short period of time? And the answer is that it takes 3, 4, 5 quarters before you get the maximum impact. So in other ways, let's talk about this as what happened to the lagged effects of monetary policy. Inflation is coming down, but what about growth? And I think the narrative will now shift away from saying inflation looks better, the trend is better, we're still at a high level. But what about this idea that when we step on the brakes, you will see monetary policy having a negative impact on consumption, on capex spending, and that's exactly what we're seeing. You see same-store retail sales is coming down, you're seeing capex spending coming down, default rates are going up, delinquency rates are going up. It is beginning to bite, as you're saying, Lisa, in the background. So we will and should still expect to see over the next several quarters a continued slowdown. This is what the Fed wants. This is the whole reason why they're raising interest rates, to get the economy to continue to slow down.
That's worked out well. I got 14 ways to go here in our 2-hour conversation, but I've got to drive towards the arch overlay here, which you think about at Apollo, and I'm going to go to Paul Romer, the great growth economist, the great economist thinking about technology. Are we just fooling ourselves in that there's a technological overlay where the haves of all incomes are benefiting from technology, and there's a whole other Luddite part of society that's not participating?
Well, at least on the AI front, it's certainly something that's more happening in financial markets than out there in the real economy.
What about out in the real economy? I'm thinking about your Germany flat on its back right now.
No, well, the bottom line is still that the Europeans are definitely, of course, experiencing some headwinds as a result of the AI boom that we're seeing in the US at the moment. Unfortunately, we're not quite seeing that in the productivity data as we speak, but you're right, over time, this will certainly be something that helps. I don't think this matters so much for the business cycle in the near term and for the Fed, but I do think that it does matter for discussions about the potential growth rate of the U.S. economy.
Just quickly here, you were talking about how as inflation comes down, that's when you start to see revenues come down. Is this sort of the unspoken reality that actually inflation was positive for companies, increased their revenues, and allowed the growth?
Oh, absolutely. This is spot on, because inflation is not only about output prices, it's also input prices. In other words, things that are sold when you have high inflation could have wider profit margins. But the cost of production were also very elevated. And if all that comes down, it's not only helping in terms of lower cost of production, it's also going to squeeze margins.
What we're going to do here, folks, is we're going to do a data check, because we do have markets on the move after what we saw with Lisa Abramowitz's PPI data. We're going to keep Torsten Slok with this conversation so timely right now, with futures legging it out. Futures nicely up 15. NASDAQ futures up 0.7%, have a life of their own. I'll let Lisa explain that. Yields come in constructively. And again, as Stephen Englander said from Standard Chartered Bank, there seems to be a game-changing tone to the market. Brent crude 80, and I'm really watching DXY. For DXY to break under 100 would be a huge deal today of a weaker dollar. The percent move on the Standard & Poor's up 0.3%.
I keep thinking, Tom, about what Torsten Slok just said, and we heard a similar kind of discussion from Tony Dwyer, that when revenues come in, that is when it is a game changer. And perhaps one of the most understated, and also misunderstood aspects of inflation was how much it boosted companies' revenues, how much it boosted a lot of the growth. And all of a sudden, when you start to see inflation come in and revenues don't increase at the same kind of levels, then how much do you see a resetting back to a normal type of economic
This is where
backdrop?
you impute the inflation in the system. The giant Phil Correa, value investor, pioneer in New York, lived to be 104, whatever. Nominal GDP is the great misguess right now, isn't it?
Absolutely. And what's really critical about this is that equities trade on nominal data, bonds and rates trades on real data.
Stop the show. Guys, frame that. Give that to every show this week. Say it again. Nominal GDP matters.
Because what matters for nominal earnings in the S&P 500, which has grown 6% annually for the last 40 years, is all about nominal variables and nominal GDP, nominal revenue. Everything is measured in nominal terms. So when inflation comes down, you should also expect the bond market to look at that and say, well, that's not for us. That's what's happening in equities. Whereas bond markets will say it's all about what's happened on the real side, meaning on the volume, on the unit side.
Torsten, thank you so much. Greatly, greatly appreciate this today with Apollo as well. This nominal, people go to me, why are you talking like that? Why does Michael Darda talk like that? Why does Torsten Slok? It's a nominal world out there in the CEO corporate world.
We used to think that inflation would be bad for stocks because bond yields went up. It turns out maybe not.
I just had a nightmare. Do you think Torsten Slok's ever had a Cheez-It? Frito-Lay, up 14% revenue. There's your nominal world. Good morning, it's Bloomberg.
Sports and money, they've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
From the world of politics to the world of business. Every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
We have great news today that inflation has been cut by 2/3. So my message is take yes for an answer, Chair Powell, and let's stop with the rate increases. Done.
The economist, Elizabeth Warren, as I said earlier, hugely capable, whatever your politics and bankruptcy law, which maybe is a monetary theory. But you think she's looking at it to John, the tension between me and John and the victory lap of the Fed and all that. And Warren's going, would you guys just look at the facts, please?
I love it. Just done. Guys, yes. The answer is yes. Is that what she said?
Move on.
Move on. And that seems to be her theme. Of course, if this does continue or the jobless claims show strength and we see disinflation for now, when does that create more of a concern about sticky inflation?
I say to the Fed, I'm going to give them some major slack here. They're by definition ex post. They're always late as they were on transitory. We got a very interesting Fed schedule, July 26, September 20, November 1, December 13th. And we're in like 4 places for this. I think we're coming to you on the schedule from London at some point. I think we're coming, John has, I think, November 1 or from some island near Capri. We're doing the Fed decides from some island near Capri. I don't know, it's going to be eventful, but the Fed meetings will be extraordinary. Watching that will be Ira Jersey, Chief U.S. interest rate strategist for Bloomberg Intelligence. Ira, what bond data did you watch yesterday when we saw a game-changing report? What was the thing that moved, or the elasticity of movement where you said, oh, wow, that signals it?
Well, given that we had the CPI data and that affects the TIPS market, we were looking very closely at what happened to the Treasury inflation-protected market, the two components of it. So firstly, what did the inflation expectations do, which actually didn't do very much at all, which surprised us a little bit. But importantly, real yield, so the yield on the actual TIPS instruments came down a lot, and they're continuing that rally this morning. And in part, that I think that's an acknowledgement that the Federal Reserve's not going to go the 50 basis points that the dots said, and certainly not as far as the market had feared earlier in the week.
I'm going to steal the thunder. 5-year real yield here, really something, folks, coming right back to middle June levels is how I'd put it. Ira, I'm going to steal from Bramo here and go, what does this do to the corporate spread market? Because the big theme here has been, frankly, corporate spreads out front have indicated more optimism. They've been very narrow. What does other debt do off of your full faith and credit world?
Well, so I think, investment-grade corporate spreads, I think it's going to become much more idiosyncratic in a lot of the spread markets, in particular because when you have this contraction of CPI coming down, but also producer prices came in this morning not quite as high as the market was expecting, you could have a bit of a contraction in margins for some firms. But that being said, corporate balance sheets are much cleaner than they have been over time. So you're not going into this crisis, and you're not going into this slowdown that we're seeing in the economy the same way you did in, say, 2007 or even 2001, when you had significantly more leverage in balance sheets, particularly for better rated companies.
We were just talking, Ira, with Torsten Slok of Apollo about the lag effects of monetary policy. He was saying we do expect to see weakness down the line eventually from the Fed raising rates as much as they did. A viewer wrote in and said, why do we think that monetary policy works at all if the Fed was holding rates at zero for more than a decade, thinking it would juice inflation, and it didn't? Is there a possibility that the transmission mechanism is simply broken?
Well, I don't think it's broken. I just think it's changed, and that the lag is much longer now. So when you go back to the 80s, 90s, and the early 2000s, you had much more short-term debt held by both the household sector and businesses. You had a lot more commercial paper. You had even the banking sector. You had a lot of pass-through from monetary policy because they funded with repurchase agreements and commercial paper, so very short-term debt instruments. Today, that's been termed out quite significantly. So I do think that there's an impact that monetary policy will have. It's just that it's going to take much longer, because now you have to wait for the housing market to slow. You have to wait for the interest rates being higher to feed through the economy a lot more, because in order for corporate weighted average cost of capital to go up, you have to wait for a lot more debt to mature, and those maturities are not as there's no wall of maturities that's going to suddenly be refinanced and increase those costs of capital. So I do think monetary policy has similar effects. It's just that the lags are longer maybe than what we've been used to in the post-war period so far.
Here's the problem, though. The market is a forward-looking instrument, and you're seeing bond yields already coming down on the long end, much more than on the front end, because people are expecting we will normalize and that monetary policy will work. And yet that offsets the tightening that you could is all working. So if anything, we're seeing an easing in financial conditions that will actually allow companies to more easily refinance, et cetera. So again,
Lisa,
I ask,
but that's not new. That's not new. The same thing happened in 1981. The same thing happened in the early 90s. The same thing happened in the aughts when Alan Greenspan talked about the conundrum, right? And so this is just a natural reaction to higher front-end yields means that the market's going to, as you said, be forward-looking and say, hey, what is the Fed going to do? Where are interest rates going to be 3-5 years from now? So one of the scenarios that the market could realistically be pricing right now is for the Fed to do nothing for the next 3 years and then cut interest rates to 2% and keep them there. So if that's a possible outcome, then the 10-year yield right now is at fair value based on that series of outcomes. 5% interest rates in the front end for until 2027, and then suddenly they go down to 2% and stay there.
Many talk and opine like people in bow ties who really don't know what they're talking about, and others do. We're going to stop the show right now and go to the single person I know who knows more about American soccer than anyone on the planet. Ira Jersey does this. He's been committed to it for years with youth soccer in New Jersey and on. Ira, let me begin with Mr. Messi and the MLS. Can the rest of the players of the MLS keep up with the greatest player in the world?
Well, maybe not at home. You know, one of the things that when players come over from Europe to the United States is they don't appreciate how much travel there is in the U.S. and how vast our country is. So it's not the same as taking a train or a bus on a couple-hour trip in England or Spain and a lot of the European countries where these players come from. So I think that's the great equalizer. You know, obviously Lionel Messi is the GOAT, right? He's the greatest of all time, almost it is almost undisputed. So you know, him coming to Major League Soccer, I think, is good for the game here in the sport because it brings a lot of attention to the game and will help grow the sport in general.
Bramos right now to World Cup 26 tickets this weekend. 1 + 1 + 2 + 4 + 8 + 16 + 72, 104 matches. Steal us here. Is this going to be like 70, 80,000 people in a stadium with all, you know, around the country? Is this going to be a big a deal as European soccer people would suggest?
I would doubt that. I think that almost every game will probably be near sold out, if not sold out. You know, maybe not a few games. It is a larger World Cup, so it's the first time they're going to a 48-team World Cup. So there are some smaller countries that maybe won't have the international appeal as some of the others. But it's hard to imagine, you know, the big games and the knockout rounds not having sold out crowds. You know, a lot of the stadiums that they're playing in, things like, you know, Lincoln Financial here in Philadelphia or MetLife Stadium, they're going to be sold out. I remember going to Copa America in 2016 with my son, watching Lionel Messi play with Argentina against Chile, and that was a sold out stadium too. And that was, you know, that was just a Copa America. That wasn't including, you know, this wasn't a World Cup. So this is even a bigger stage. So it's hard to imagine you don't have great attendance at these matches.
Ira Jersey, you are the best. He is the coach that everybody talks about in the madness of American kids sports. Ira Jersey, excellent on interest rate strategy. He's the one, and I coached Little League once long ago and far away. Yeah, with parents telling you what to do. Why isn't my kid playing shortstop? and there's so much trauma now in American kids sports that people like Ira Jersey are just going, do I need to do this? And Ira is just totally committed to it.
Were you one of those dads who basically said, if you don't get 3 home runs, don't come home?
No. You know what I was? I was the one where the moms came up and said, would you please be the assistant coach? Because the head coach thinks he's in the NHL. I mean, really, they would literally come up and beg me because I'd be out there laughing, making jokes with them. The guys like Ira Jersey are treasured. I mean, this is something really special. These guys that are out there every week doing kid sports.
Or Stadia?
I don't know. If you go to Chicago, it's probably Stadia. What do I know? Futures up 16. The VIX 13.4. This is important. Stay with the markets here for the next 35 minutes. It's going to be quite an opening. From New York, this is Bloomberg. Good morning.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Keeping the faith in billionaire Warren Buffett. The legendary investor turns 93 this August. His signature must-read letters to shareholders have been getting shorter and shorter. This year's letter contained few fresh ideas. But most investors in a Bloomberg survey say Buffett's steady Eddie approach of buying cheap, safe, high-quality companies will beat the market. They expect returns in his investment company, Berkshire Hathaway, to outperform the S&P 500 over the next 5 years. adding to an incredible run in which Berkshire shares have returned more than 3 million% in the almost 6 decades Buffett has led the firm. Investors are also willing to pay up for Berkshire, which owns everything from the railroad BNSF and car insurer Geico to See's Candies and Coca-Cola. About 1/5 quantify the Buffett premium at more than 10% of Berkshire's stock price. More than a quarter say it's somewhere between 5 to 10%. There is one problem for Berkshire Hathaway, its size. Thanks to a bunch of cash-generating insurance companies, Berkshire has at least $130 billion in cash that it can put to work. But it needs big acquisitions to move the needle. Buffett calls it hunting for elephants. And we know Buffett hates overpaying. So that means sitting tight, patiently waiting for the right moment to pounce on the right company, which might be a drag on performance for now, but as Buffett fans know, usually works out in the long run.
So let's go inside the boardroom. Let's suppose you win a proxy fight and or you just get invited onto the board. You go to your first board meeting and you're the person who's saying you can fix this company, and all of the others on the board of directors are saying, well, we're doing pretty well. How do you get received when you start saying, here's what I wanted you to do?
Well, first of all, we don't bring that to the boardroom. Our time is spent with the CEO, the chairman, the CFO, and share our plans with them outside the boardroom. We try never to solve an issue in a boardroom. Okay, it's always best done the day before, the week before, outside that room. We wouldn't be there if they really were doing well. So it's really hard for them to straight face and tell us we're doing well. And we present them with a plan.
This is Bloomberg.
Here's a recipe for a rally. The data, PPI, CPI coming in a little bit softer. Jobs data, jobless claims a little bit lower, and earnings, upside surprises. Equities right now up 0.4%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open, with Jonathan Farrow.
Live from New York, coming up, equity markets climbing for a 4th day as earnings come in better than expected and hopes grow. Chair Powell is almost done. We begin with the big issue, disinflation, hopes and dreams.
We're seeing disinflation in the U.S. economy.
Broad-based disinflation.
Disinflation everywhere.
This was a good report.
A step in the right direction.
An extraordinarily good print for the Fed.
Disinflation is starting to take hold.
Inflation has been coming down.
We should get even better numbers in Q3 and Q4.
It's premature to declare victory on the inflation front.
I don't think it changes the move in July from the Fed.
July is, pretty much assured.
Pretty much a done deal.
It's what they do afterwards.
The real debate is in later this year, September, November.
There's a lot of time between now and November.
They're going to be watching the data.
It's very, very difficult for anyone to know exactly what happens from here.
Joining us now to discuss, Darryl Cronk of Wells Fargo, Richard Bernstein of RB Advisors. Darryl, first to you. How close are we to the end of this hiking cycle?
I think we're still a ways away, John. July is, as you just alluded to, in the books, but we still think probably out in September or November, the Fed's going to have to do more. Everybody cited the 4.8% year-over-year core. What was good news yesterday in the CPI report, I thought that somewhat got unmissed, though, is if you looked at the core monthly rate, it was 0.16%. You annualize that, that's less than a 2% core inflation number if you could annualize it. The problem is you're going to lose the goods sector with the tailwind it's providing and been providing from goods and manufacturing, and you're going to be left with services and labor and everything else that's been sticky on the inflation front.
Richard Bernstein, your view on the same thing?
So John, I think it's the point about the second half of the year, I think, is very important. In some commodities and things like that, we're going to have pretty easy comparisons as we head towards the end of the year. And so I think the jury should stay out on whether the Fed is done or not. But I think that, John, that may be a separate issue from whether the reaction in the stock market and what's leading the stock market is correct if one believes that the Fed is near the end of the cycle.
Well, let's talk about the data. Wage growth is still decent. Inflation is coming in. Isn't that good for risk, Richard?
It's good. It's good for the overall economy. But if it's good for the overall economy, why is it good for only 7 stocks? Right? I mean, that makes no sense to me. If one believes that the economy is going to have a soft landing, if one believes that job creation is going to stay healthy, if one believes that consumer spending is going to stay healthy, et cetera, why would it only be 7 stocks? That makes no sense. 7 stocks might be the correct outcome if you believe we were heading for depression when only 7 companies could possibly grow. But John, I'll just point out to you that earnings growth in Europe is the same as technology now as we look towards 2024.
Well, Richard, the problem is,
it's kind of nutty.
As you know, they're just the 7 stocks we talk about. Let's talk about Delta this morning. Beat and a raise. Stock is up in the pre-market by 3.5%, up almost close to 50% year to date. Take the top 10 on the S&P 500. 3 of those stocks, 3 of those 10, they're cruise operators. So, Richard, is it just about 7 stocks, or is it about something else?
Well, I think, John, look, I believe that the stock market is a seesaw and that we've got basically 7 stocks on one side of the seesaw and literally everything else on the other side of the seesaw is attractive. So, you know, when we start talking about the broader stock market, we start talking about other sectors, I think they're actually quite attractive. Somehow that gets me painted as a bear that I don't like the 7 names, but I think there's actually lots of attractive opportunities out there.
Well, Daryl Cronk says this, it's all multiples. You're underweight equities. Daryl, why?
Yeah, I think when you look at, you know, certainly the historical measures, it's hard to believe you're going to soft land this thing with this time is different argument. If you look at the fundamentals, I mean, there's just not much to get excited about. PE multiples, there's not much to get excited about. Earnings risk premiums at these levels, you're just not getting paid to take risk. And then when I look at, you know, more specific things like the put-call ratio showing a lot of complacency, I just, you know, you're not getting handsomely paid to take risk at these levels. So we would probably fade this rally in the back half of the year and look for better entry points where you're going to get paid. Everybody knows that all of the rally in 2023 has come from multiple expansion. None of it's come from earnings growth. In fact, when we put Q2 in the books, if you just believe in consensus, earnings will have declined, John, 11 to 12% over the last 3 quarters, which means that now you've got 3 quarters of negative earnings growth, you've got 6 quarters of margin declines, and you will have had 2 quarters of negative real revenue growth. All of those are consistent with not a soft landing, but a recession.
Rally continues this morning, up 0.4% on the S&P 500. No talk of recession at the moment. The Nasdaq up by 0.8%. Futures are higher. A fresh batch of economic data coming out about 35 minutes ago. Bloomberg's Mike McKee can break that down for you right now. Morning, Mike.
Good morning, John. And it was another day of good news for people in just about every market, I guess, because PPI, while it doesn't have a direct relationship to CPI, does show that cost pressures on American businesses are starting to fade. They were up, PPI was up only 0.1% in the month of June, and on a year-over-year basis was up just 2.4%, down from 2.8% the prior month. So some progress being made there. Core CPI 2.6%. And then jobless claims come in lower than anticipated and lower than they were last week. So no sign of layoffs in the U.S. economy at this point that would presage any kind of problem in the labor market. And as I am out here at the Rocky Mountain Economic Summit, I'll take you back 1 year when Fed Governor Chris Waller appeared here. And here's what he had to say, noting the large number of job vacancies that we had at the time. Some people, he said, have argued that past experience indicates we cannot reduce this large number of vacancies without a big increase in the unemployment rate. But I have showed that past experience actually indicates a reduction in vacancies can take place without a big loss of employment. And this is the kind of soft landing anticipated by FOMC participants. So that was a year ago today. He looks to be prescient. And at least at this point, it does look like the Fed keeps the soft landing scenario on the table. even if they have to raise rates one or two more times.
So far, so good. Alive for now. You mentioned one Fed speaker. Here's another. Thomas Barkin of the Richmond Fed, had this to say, Mike McKee, our target's 2%. If you back off too soon, inflation comes back strong, which then requires the Fed to do even more. Mike, would you say, based on the Fed speaker the last 24 hours, this Fed is less excited about that print than maybe this market was?
Oh, definitely. It's one print, but it does show progress. But B, they know what happened in Canada and Australia when their central banks declared victory. They had to come back and raise rates again because inflation went back up. And they're also looking at financial conditions indexes, which have eased in recent weeks. And that suggests that they may not be tight enough. So look for the July 26th rate increase, and then we'll start looking at the data to see whether they do something in September or November.
Mike McKee on the latest data. Mike, thank you. As always, if you are just joining the programme, welcome to the programme. About 38 minutes ago, economic data, PPI, a bit softer, following softer CPI yesterday, together with jobless claims coming in lower than expected. That's good news. Earnings from PepsiCo, better than expected. Earnings from Delta, an upside surprise. So equities push on, higher. Yields push lower, down by 9 basis points, 466. And if you check out the FX market, take that bond market, push it through foreign exchange. The euro stronger for a 6th consecutive session. New highs for the year, the euro against the dollar, 111.80. We're positive on that currency pair by about 0.5%, just short of 112. Daryl Cronk, Richard Bernstein still with us. Richard, I want to go to you on the euro. The dollar weakness that's emerging. You mentioned going abroad to Europe. Talk to us a little bit more about it.
Sure. So John, Americans have become very geographically myopic in their portfolios. It's all about the United States 24/7, 365. But I think there's plenty of opportunities going on outside the United States. I mentioned before that if you look at the relative earnings of Europe versus the relative earnings of tech here in the United States, you'll find that Europe's relative earnings are actually going up relative to tech. So it's a question of, are there growth stories around the world? The answer is, yeah, there's quite a few. Now, if the dollar starts weakening, if people believe that the Fed is going to start taking their foot off the brake, at the same time that non-U.S. is going to be continuing to tighten. And I want to point out that around the world, you have a record number of central banks engineering inverted yield curves. So the rest of the world is very, very tight. Any notion that the Fed is going to ease up here is going to cause the dollar to weaken, which of course makes non-U.S. even more attractive to U.S. investors, something that we haven't had to talk about for quite some time.
Well, we can talk about it right now. Daryl, is it all about the U.S. or not?
No, it's actually, I think Rich is exactly right here, John. So the transmission mechanism that is the most acute of what's been going on the last couple of days is in the dollar, right? You've had 4 straight dollars weakness days, the most and the largest since November 2022. We're on a 15-month low for the dollar, right? It is pushing money into emerging markets, it's pushing it into developed markets, it's pushing it into commodities, actually. Gold and silver are rallying off their base right now, which makes a lot of sense with that kind of dollar weakness. So what's interesting is it's not just the earnings growth that Rich points out, but it's the valuations in Europe. When you look at the French CAC, the German DAX, both are sitting close to their March, April lows for the year up until the last maybe 24 hours. Good value there, right? Investors should take advantage of that. Japan, as we know, has been one of the hottest markets of 2023 so far. It doesn't get the press it should with everything happening in the U.S., but Rich is right. I mean, we haven't talked about developed international or emerging markets in a decade, and investors are candidly wildly underweight there.
Well, just one extra beat on developed international. Richard, let's mention Europe. Germany in recession. Data out of China is not great. What is there to like?
Well, I think, John, just in terms of Europe overall, and whether it's Germany, France, wherever, I think you're looking, as Daryl pointed out, you're looking at very cheap valuations. That's nothing new, right? Europe's been cheap forever and a day. And I think many people have been disappointed in the results by just buying cheap assets. But what I've alluded to and what Daryl mentioned as well is that there's an earnings story. The relative earnings in Europe are starting to pick up. That's something new. And I think it's something that investors haven't even started to think about. So, I mentioned the seesaw before. You got to remember in 2022 when the seesaw went in the other direction, 70% of non-U.S. markets outperformed the U.S. in dollar terms. I really mean that there is a lot of opportunity on the other side of that seesaw. And if it does go back in the other direction, which I think eventually it has to do, Non-US is going to do really, really well.
Richard Bernstein, alongside Daryl Cronk, will continue this conversation. A headline coming in from Amazon just moments ago. The first day of Prime Day, the single largest sales day ever. Stock is up by 2%. July 11th, the single largest sales day in company history. This off the back of this recession conversation through most of this year. The data of the last 24 hours and some corporate commentary pushing back against that. Let's get you some movers. We can do that with Abby. Morning, Abby.
Morning, John. And we do have the S&P 500 E-mini futures heading to a fourth up day in a row, the first time we've seen that in about a month. And some of those earnings winners, well, that's a big piece of the story. Starting it with Delta Airlines, the stock is up 3.8% at its highest level in the pre-market in about 2 years or so. This after they put up a very strong quarter, but most importantly, raised the outlook, the rebound in international traveling. The CEO is saying that there's significant growth yet ahead. Very bold. Flying is the #1 priority for discretionary spending. PepsiCo up 2.4%. They also raised their sales and earnings estimates. It looks like organic revenue could probably, they're saying, grow about 10% this year after a 13% gain in the past quarter that was just reported. So folks are still paying up for those products. And then finally, Alphabet up 1.5%. We continue to have the relief rally in big tech after that CPI number yesterday, PPI now, and there you have Alphabet up more than 1%, John.
Abby, thank you. Those earnings from Alphabet coming July 26th. Before we get there, bank earnings kicking off tomorrow morning. Wells Fargo, Citi, JP Morgan. Then the rest pushing ahead to next week. Coming up, the White House taking credit for lower inflation.
The economy is defying predictions that inflation wouldn't fall absent significant job destruction. We saw new and encouraging evidence that the economy is on the path to moderate inflation accompanied by a resilient jobs market.
That conversation down in D.C. up next.
Maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question. Best question I get all night.
Bloomberg, top experts, great questions.
DOJ or other authorities.
Could face bigger challenges next.
Was going to keep rain while come. This is a 3.
As the economic picture down.
Is it the okay is getting ready to make a decision?
The economy is defying predictions that inflation wouldn't fall absent significant job destruction. We saw new and encouraging evidence that the economy is on the path to moderate inflation accompanied by a resilient jobs market. Those economic gains haven't happened by chance, and they won't be sustained absent a deliberate strategy. President Biden's strategy is aiming to grow the economy from the middle out and the bottom up, which is a fundamental shift from a top-down economic approach.
The White House touting its economic policies after U.S. inflation hit a two-year low. The president taking a victory lap, writing this. This report brings new and encouraging evidence that inflation is falling while our economy remains strong. Good jobs, lower costs. That's Bidenomics in action. Senator Warren using the data to ramp up the pressure on Chair Powell.
Inflation has been cut by 2/3. So my message is take yes for an answer, Chair Powell, and let's stop with the rate increases. Done.
Bloomberg's Katie Lyons and Karen join us now from Washington, D.C. Katie, you spoke to the senator from Massachusetts. What was the message?
Well, her message has stayed relatively consistent over the last several months, John, which is that inflation is on the right track. Therefore, the Fed should stop hiking rates for fear of what it will do to employment in the U.S. and the potential for the unemployment rate to go up. And as we were just hearing from Lael Brainerd and what we have heard from the Biden administration is they are touting the fact that inflation is on the path down while the labor market has held in. The concern is once the lagged effects of monetary policy tightening really kick in, that the labor markets could start to soften and the economy could start to soften as well, which is a very politically difficult question for Democrats and the Biden administration. I would note, though, John, while we have been hearing this message consistently from Senator Warren, others on Capitol Hill are joining her as well. I was in the House yesterday speaking with several members of the House Financial Services Committee who also told me that they would like to see the Fed stop hikes. I actually spoke with one Republican congressman, Roger Williams, who said that he would like to see the Fed cut this month, not hike. The question is the Fed actually going to do as many politicians would like them to do? Granted, I spoke with others as well, Congressman Brian Stile, who said that inflation is still not at that 2% target, so the Fed needs to remain vigilant. For now, though, the numbers are working in favor of those that are in the White House and affiliated with that party, John.
Unlikely they'll get those cuts anytime soon, at least not this month. And Karen, we started this program by talking about disinflation, hopes and dreams. Let's talk about soft landing hopes and dreams. Are we getting a little bit too carried away?
Well, certainly a lot of people are talking about a turning point now, given where the inflation numbers are at. And you would have to say the recession bears, it hasn't been a good time for them, John. The labour market's holding up. Inflation is heading in the right direction. But as Kayleigh just mentioned, really the hard yards start now. We know there's going to be a lag effect from those increases in interest rates. We know that there is some softening in the jobs market. There's a weakness in the manufacturing sector. Look at the PPI numbers coming out this morning. So I think that, yes, right here, right now, inflation's in the right direction. But we don't know, A, what the broader economic impact will be a few months from now, or B, whether or not there will be a resurgence in inflation. Look at some of those core indicators are still quite sticky. So I'd say there's a way to go on this yet, John.
Darryl Cronk saying the same thing about later this year. Just keep an eye on the ball. And Karen there, Katie Lyons. Katie, great interview, by the way. Fantastic work, as always. Down in Washington, the both of them. Still with us, Darryl Cronk, and of course, Richard Bernstein as well. Richard, we talked about the pre-pandemic regime, low inflation, low growth, low interest rates. Any reason why you still believe we don't go back to that?
I think it's very difficult to go back to that right now, simply because the labor market is so tight, right? I think one of the things that everybody is talking about is the lagged effects of monetary policy. Virtually nobody is talking about the lagged effects of fiscal policy. We had, the big Trump stimulus plan, then we had the Biden stimulus plan, the Inflation Reduction Act. It's hard to argue that that is 100% through the economy and the multipliers haven't been felt yet. And I think that's what you're seeing in the labor markets, is the labor markets are being very resilient despite what most people had forecasted. So I think that to argue that the Fed should be on hold or the Fed should be cutting, which seems very extreme to me right now, when core inflation is 4.5% to 5%, your target's 2%, that seems very premature. But I think that's starting to get baked into some asset prices.
Well, politicians, Richard, they care more about political cycles than they do about economics. Darryl Cronk, do you agree with Richard?
Yeah, I think he's right. And I don't doubt the politicians want that, because heading into an election year, they want the economy to be hitting on all cylinders and rolling forward. I think what's interesting, and most people haven't paid attention to this, but if you go back, John, to March of 2022, right, which was the very first Fed hike, right, and we did 500 basis points and we'll do more at the end of this month, what was the unemployment rate in March of 2022? It was 3.6%. What is it today? It's 3.6%. Right, there's been zero progress in softening that labor market, to the point made earlier. From the Fed's lens, right, the way the Fed's going to look at this, and Chair Powell's going to look at it, is still too many jobs being created, unemployment rate is still too low, and wage growth is still too high. So the idea that they're going to be cutting soon, I think, is a fool's errand. And in fact, the Fed's been very clear to say the risk here, the mistake, if there is one that could be made, is not that the economy softens or you even get a mild or moderate recession. The mistake is you lose the anchor on inflation.
So, Darryl, forget yesterday's news. Let's get out to the end of August. I'll be there,
Yep.
Jackson Hole, Wyoming. Fed chair's likely to speak again. Compare and contrast what you expect to hear in August with what we heard last year, because to your point, last year he talked about pain. Unemployment then was around 3.5%, and right now, as you've pointed out, unemployment is still around 3.5%.
Yeah, and I think what you're going to hear in Jackson Hole is, look, progress has been made. There's no doubt, right? Maybe not on the unemployment rate, but certainly inflation has come down. The Fed has its dual mandate, right? Let's not confuse the idea that full employment is one side or one half of the dual mandate. So they like the fact that the job market has been able to do this. He could be the wizard of the economy in Wall Street if he can truly soft land this, because historically, with this kind of monetary policy tightening, it's just really never been done, right? So this time could be different, and he could become the wizard, but I'm not sure. In Jackson Hole, you're going to hear, look, a lot of progress has been made, but there's still work to do. We're not confident that inflation is fully under control, and the greatest risk is to lose the anchor on inflation.
I've got 1 second left, Richard, but I've got to squeeze this in. Message from a Bloomberg subscriber, from a gentleman called Jason. You might be familiar. Love RB, but he's got to get rid of that Rangers jersey behind him. Happy to send him a Devils jersey. Do you know who that is?
No, I don't know who that is, but there is no way a Devils jersey is being hung in this office. I'm sorry.
Richard Bernstein, Darryl Cronkton, the two of you. Good to catch up. Coming up, the morning calls, and later, State Street's Laurie Heinel making a case for holding cash despite seeing further upside for stocks. That conversation up next.
Are facing some tough challenges. Higher living and education costs and wages that aren't keeping up with inflation are making it harder for them to support themselves. And they're relying more on the bank of mom and dad. A new Bankrate report shows nearly 70% of parents with kids 18 and older are putting their own finances in danger to help them. About half are dipping into their emergency savings or delaying paying off debt, while 43% drain their retirement funds. So where do you draw the line? There seems to be a generational gap, as older parents can't understand why being self-sufficient now is a lot harder than it was for them. Gen Z seems to think on average that 22 is a benchmark for covering the expenses, while baby boomers say their adult children should pay their own way closer to age 20. Either way, it's a family decision. Bankrate suggests having a conversation with your kids and setting a specific dollar amount or time frame for footing the bill.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
From the opening bell, equities doing okay, up for a fourth day on the S&P, up by 0.4%. That's the price action. Let's get you some morning calls. JP Morgan downgrading Carvana to underweight, saying the stock is disconnected from fundamentals. Cowen upgrading Meta platforms to outperform, expecting shares to keep rallying with consensus estimates too low. And finally, Barclays downgrading Coinbase to underweight, seeing limited upside and lingering regulatory concerns. That stock negative by 0.8%. Up next, a preview of bank earnings tomorrow, with earnings so far this morning looking pretty good.
hardest thing in life, I've often said, is to be happy, but you seem like a very happy person.
It's like nature. Nothing ever stops. So you could be super happy 1 minute and then something happens. So it's just living. It's the joy of life.
For any young woman that's watching this, wants to be the next Diane von Furstenberg, what would you recommend?
I think the most important thing in life is the relationship you have with yourself. Once you have a good relationship with yourself, any other relationship is a plus and not a must. And the second advice is to be as true to yourself as you possibly can. And you have to accept and own things you may not like, but the more you could be you, the happier you will be.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question this industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays. This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month.
Seconds away from the open about this morning. Good morning to you all. Equity futures positive by 0.4%. 3-day winning streak coming into Thursday. Let's see if we can make that 4. If you're bullish on this equity market in the last 24 hours, you probably got what you wanted. CPI softer than expected, throttling PPI as well. Jobless claims going in the right direction, lower. And the earnings so far, early days I know, but so far so good. Look out for tomorrow when the bank earnings kick off. That's the opening bell. Switch on the board and get to the bond market. Yields tracking lower over the last couple of days. We're down 5 basis points on a 10-year, 380.83. Check out the 2-year. What a ride it's been in the last week. A week ago today, we were talking about a monster upside surprise on the ADP report. We had a 2-year yield through 5.1%, and now down to 464 on a 2-year and down 10 basis points on a session. With that move, the dollar is weaker. This euro is stronger. The euro against the dollar, 111.83. We're positive there by 0.5%. For that currency pair specifically, that is 6 consecutive days of euro strength against the dollar. Crude pretty stable, 75.72, and unchanged on the session. About 45 seconds into the session, we are positive here by 0.4%. On the Nasdaq, up by 0.7. This rally continues. One stock to watch at the open is Disney. Shares moving higher after extending CEO Bob Iger's contract for another 2 years. The company saying this: the extension provides continuity of leadership during the company's ongoing transformation, allowing more time to execute a transition plan for CEO succession. Ed Ludlow joins us now from Sun Valley, where that announcement was made. Morning, Ed.
Yeah, good morning, Jonathan. Disney modestly higher, 0.4%. As you said, the emphasis on the extended period, which sees Bob Iger in place as CEO until December 31st, 2026. There's a lot that he has to fix. But it also allows for that transition, and going into Sun Valley, that was the story. Who will succeed Bob Iger? Will it be an internal candidate like Josh D'Amaro, the Parks chief, or Dana Walden, the TV chief? We learned a lot about where Iger's head's at during that interview with CNBC. All options appear to be on the table. He talked about working with Comcast to buy out the remaining of their stake in Hulu. When it comes to sports, there's a position of strength, but they're open to partnerships, and we could see divestments in some of the other linear TV properties. The way that Iger put it is that he felt he had a lot of work still to do. And there were a lot of things that in the last year Disney got wrong, and he was forthcoming about that, particularly around how they marketed and handled Disney Plus. He was quick to point out that they reached 100 million subscribers far quicker than any other streaming platform had been able to do so, but that some of the marketing around it and the pricing would need to be reviewed. It was interesting, John. I spoke to Steve Pagliuca, the co-owner of the Boston Celtics, yesterday. He's known Bob Iger for 20 years or so. He's an NBA board of governor member, right? And he makes the point that Bob Iger is very strong on sports. He's willing to invest in sports. So just as one case study, I think there's a lot of enthusiasm about what Iger will do to strengthen ESPN in particular. But no surprises here. Everyone I speak to was not surprised by this news, and they largely cheer it. They think that Iger is the right man at 72 years old.
So, Ed, why are we still talking about a successor? It's pretty evident to me that he's it, isn't he?
Yeah, it's interesting. I mean, I heard from sources that this process of finding a successor has been ongoing, like it's been happening in the background. And again, as per the interview with CNBC, Iger really emphasized this. They felt they needed more time to make a smoother transition. You know, at age 72, he described having a passion for the job, but I think, you know, they learned the lesson from Chapek and that they just need more time to do it. How long he'll be there, will it go beyond 2026? Who knows?
If you can lead the country at 80, I'm sure you can run Walt Disney Company at 72. Ed Ludlow, thank you, sir. Let's get to Meta. Shares of Meta, the FT reporting that the company is poised to release a commercial version of its AI model, helping the tech giant compete with the likes of Microsoft and Google. The stock is up by 1.65%. Abby has more. Abby.
Hey, John. Well, yeah, shares are really popping up for a fourth day in a row. In fact, over the last 4 days, up about 8%, the best 4 days since early May. And now this possibility of commercialization of their AI to compete with, as you mentioned, Microsoft and Alphabet, really a piece of the story. Now, they are planning on releasing that version of their artificial intelligence model that would basically allow startups and businesses to build custom software on top of the technology, very similar to Microsoft and Google, who really dominate, or Alphabet, I should say, who really dominate this space. But one thing that's interesting, John, this is just one piece of the puzzle. You know, some years are hot for companies, some years not. Last year, Meta down 64%, its worst year on record as investors. Not only did we have bearish market tone, but fretting about the metaverse and what it would mean, and that Mark Zuckerberg might just go unfettered in terms of spending. But now we have the year of efficiency, we have Threads, and now we have AI. This stock, John, on the year up more than 160%, heading to its best year ever.
Unreal, up about 1.6% right now for the year-to-date number, as Abby just said. Just move the decimal point over just a few figures. Shares of Meta getting a boost from Cowen right now, upgrading the stock to outperform, writing this. We think there's a room for further upside for 4 reasons. Consensus estimates are likely too low. The potential monetization from real and other sources, surfaces. Monetization options for its new Threads app, and potential for further cost cuts as well. Stock likes it across the board here. Better news for this company over the last 6 months or so. We're up there by 1.95%. Now up by about 2%. Let's turn to earnings season. PepsiCo delivering another beat and a raise this quarter. The CEO writing, quote, "Our strong performance gives us confidence that our investments are working. We'll look to elevate our focus on productivity initiatives and sustainability to win in the marketplace and fortify our business for the long term." Katie Greifeld has more. Hey, Katie.
Hey, John. It was a beat and raise indeed, and results topped expectations nearly across the board, even though we heard from CFO Hugh Johnson that the average price across Pepsi's lineup rose by about 15% in the quarter. Evidently, though, that's not scaring consumers away, and that growth is actually expected to continue. If you look at Pepsi's forecast, organic revenue growth will likely grow by about 10% this year, and that EPS should increase by 12%. So that's the good news. The potential bad news is that the World Health Organization is expected to release a report later this week about potential health hazards around aspartame, of course, the artificial sweetener that's used in a lot of Pepsi's products and its rivals' products. So CFRA analysts say that that could be a risk for Pepsi and for others. But for right now, John, shares are up about 1.5%.
Katie, thank you. Pepsi doing better. Down to another one this morning. Let's turn to the airline. Shares of Delta hitting a 2-year high after topping earnings expectations and raising its full-year guidance. The CEO saying this: consumer demand for air travel remains robust. There's significant growth still ahead. George Ferguson of Bloomberg Intelligence joins us right now. George, the stock is up by another 2%. It's absolutely flying, forgive the pun, so far year to date. George, why do you think this can continue?
So, I mean, I think that, probably leisure demand is very strong, and that's what we saw during the quarter. Demand into Europe was really, really strong. And I think this absolutely continues into 3Q. Probably a good portion of it's really already baked in, right? They've already probably sold the tickets Fuel prices have been dropping, and that's given the airlines a real tailwind, and that's helped driving some of this performance. To us, the big question is, once we get past 3Q, will business demand feather in 4Q and 1Q and support this level of profitability? Plus, I think, we've seen a real, again, strong bounce back in consumer demand for air travel. It's a bounce back from the pandemic, and I think this was the year that everybody had to get back to Europe after not going for 3 or 4 years. The question is, will this persist into next year, especially if the economy slows? So that's what we're thinking. But again, I think 3Q is probably in pretty good shape already.
George, I was in the same boat. I felt the same way. Can we discuss airfares? Yesterday, the CPI print told me that airfares are lower. Your experience when you look at these companies, what's happening with airfares?
So, when we look at yields, which are really synonymous to us with airfares, they were up like 17% into Europe. Again, Delta said they flew the biggest schedule into Europe ever during the quarter. So they really stepped on that market, I think, to get these great results. The issue is domestic, though, yields were flat. And indications were also that load factor is probably coming down a bit on that domestic business. So I think we've seen already some of the consumer perhaps waning a bit on domestic. Again, it bounced back earlier, so we're not seeing as much of that. I've got to travel somewhere in the U.S. Demand. Now, fuel prices have fallen pretty significantly, so the airlines do have room to give back some of those gains on fuel to support demand. We expect that they will, right? But I think we don't see a consumer that's going to continue to be just ready to pay whatever the next higher price is for an airfare.
George Ferguson on the latest with Bloomberg Intelligence. Thank you, sir. Delta up by 1.4%. Sticking with discretionary spending, Alpine's Sarah Woods questioning how much longer the consumer can remain resilient.
You're seeing it in the activity because people, in fact, are traveling and doing a lot more than they were able to do for a couple of years. The question is, how long will that extend? And can they continue to raise prices? And I think that's what's going to be the biggest issue for the consumer going forward.
Joining us now this morning to discuss State Street's Laurie Heinel. Laurie, wonderful to hear from you. It's been a while. Let's not leave it so long next time. Let's talk about that consumer discretionary spending. Laurie, your opinion on that. How much longer can that hold up?
Well, as long as employment remains strong, then the consumer still has some legs. But they've really been changing their buying behavior. So it's really been more about moving from goods into services. And we've seen that across every measure of the economy, whether it's in terms of the companies that are reporting earnings themselves, or whether it's even in the CPI data, where we're still seeing elevated prints on services inflation, even while goods inflation is coming down.
Laurie, you still see upside for stocks. Can you tell us why?
Well, we do think that we're looking better in terms of a soft landing. In fact, we think that the odds of a soft landing continue to increase. And so that really buoys our view on companies being able to weather some of these pressures over the coming quarters and then getting to the other side of that. So we've actually focused our equity allocations into large cap U.S., into European equities, where we actually think that there is some momentum. You've actually seen earnings hold up better in Europe, for example, than in the U.S. But we are avoiding some parts of the market like Asia and small cap.
Let's focus on large cap U.S. first. Tech getting all of the headlines year to date. For good reason, it's flying. Outperformance again on the screen on the NASDAQ by more than 1%. Laurie, do you think this can broaden out beyond those 7 names we discuss all the time?
Well, we think that it can. And again, we've got to get through this next quarter of earnings season. We've got to get through inflationary pressures, continue to subside, making sure that wage pressures remain under control. But we actually think that multiple expansion can support the market through the balance of the year. Eventually, though, we have to get to a little bit more earnings expansion. And that's going to be reliant on the ability to contain costs while enabling economic activity to remain positive and not having that kind of hard landing scenario that everybody's afraid of.
Laurie, given how much multiples have done the heavy lifting so far year today, why aren't we at that point right now?
Well, we think that, first of all, there is momentum. There's good sentiment. Certainly, the dollar weakness is actually helping to buoy U.S. equity prices because there will be more opportunities for export and things of that nature. We are actually pretty constructive on the Inflation Recovery Act because, Inflation Reduction Act, because there's going to be massive spending unleashed. So one of the things that you're going to have to do is pick your spots here, though. It's not going to be a universal rally, but finding those places that can benefit from the tailwinds.
One thing we've heard a lot of are good things about the economy in the last 24 hours. PPI, CPI softer, jobless claims this morning lower. Jobs, headline jobs growth in America, slowing, yeah, but still pretty robust. Earnings this morning, pretty decent. Do you think those themes will be captured in things like loan loss reserves, credit quality from bank earnings tomorrow?
Well, certainly, if anything, we expect some of that to be unleashed because we haven't experienced the actual losses or the bankruptcies or any of the things. And we see that across the spectrum, whether that's in high yield or whether it's other parts of the market. So one of the areas that I think will be interesting to watch is how that is starting to unwind because there isn't as much pressure or concern about a massive recession.
Where are you on the banks at the moment, Laurie?
We're pretty much neutral on banks. We're just finding better opportunities in places like consumer discretionary, in places like materials and industrials based on some of the things I talked about before. So we just see other sectors that are showing more promise right now.
Cruise lines have been flying, Laurie, not just the airlines. It's across the board here. I'm trying to work out if we just traded on yesterday's news, if that story's over, and we're going to move on to something else.
Well, it is very much a subsector by subsector story. It's very much a stock by stock story. But let's focus on, again, the consumer and where they're spending their money and the fact that they still have good employment and they still have good wage gains. And as long as we can get inflation to come down a bit more and we can get that to be sustainably lower, then we think we're going to be in a good place for the Fed possibly to even be lowering rates towards the back end of this year or early next year, which will, again, help us get more confidence that we've weathered the storm.
That performance year to date in the cruise lines, Carnival up by 124%, Royal Caribbean up by more than 100%, Norwegian up 77%. Laurie Heino, thank you. On the latest in the equity market, still looking for upside surprise in stocks. More broadly, about 14 minutes into the session, up by 0.5% on the S&P, on the Nasdaq up by 0.9. Yields are moving lower on a 2-year this morning by 11 basis points, 464. The dollar's weaker. The euro to a new session high of 111.94. Up next, counting down to bank earnings.
We're going to identify the issues that banks are going to have to pay for deposits. We're going to see that more clearly in the actual numbers. I definitely think that this earnings season is going to be super critical.
That conversation up next.
Connection lost.
So as you look back on your career, what would you say is the best investment advice you've ever received?
Probably the best investment advice that I never received, but that I've lived my whole life around, is surround yourself with really good people. I thought about it just today, like I do many times, what makes a great investor? A great investment firm is comprised of people who are optimists and pessimists and realists. Because in the intersection of the debates that go across that wide range of personalities is where you find truth. It's part of the reason I'm so focused on freedom of expression. I see it in my own four walls, the robust and fulsome debates around how we commit our capital, what defines a good idea, what businesses to build or pursue. That's what drives the success at Citadel. And I've been very fortunate in life to have always had a group of friends who really push me, who make me better. And here I get to work with 3,500 colleagues who in their ways make me better each and every day. And collectively, as a team, we've had the opportunity to have an incredible impact on the financial landscape around the world.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find.
Connection lost.
On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Today, I would say perhaps only second to AI right now, which is AI has got so much going on and folks are so excited about it. Climate tech is the hottest area to be in.
We're going to identify the issues that banks are going to have to pay for deposits. We're going to see that more clearly in the actual numbers. We're going to see that the regional banks probably have to come to terms with loan loss reserves, especially around CRE. And we're going to see probably less credit origination in general. So I definitely think that this earnings season is going to be super critical.
Wall Street gearing up for bank earnings. The biggest US lenders reporting in less than 24 hours. JP Morgan, Wells Fargo, Citi kicking things off. The numbers coming after a turbulent first half filled with layoffs and a regional banking crisis as well. Sonali Basak has more. Hey, Sonali.
John, when you look at it, all of the troubles become very expensive for the biggest banks and the smallest banks in the world. We are looking at jumping interest expense for the biggest of banks. And then you've been hearing about it all day, that deposit pricing going up for a wide number of banks. Now, if you're Bank of America or if you're JP Morgan, that still is about a couple basis points here. You're lucky if you get more than one, actually. But that gets a lot higher when you look across the spectrum, with some others having savings accounts north of 4% when it comes to savings. So pressure when it comes to deposit pricing. There are other expenses to look for that could really start to impact the bottom line. Remember, there's uneven amounts of firing, layoffs that are happening at a lot of these big banks. Those come with severance costs as well. When I talk to bankers across the street as well, they're also facing higher costs tied to travel and technology expenses as well. So a lot of pressure here on the bottom line, and then a lot of questions about whether some of these banks also need to adjust top line expectations when it comes to net interest income, given that there's been such soft lending across the board when you look at different types of businesses.
Sonali, let's build on this a little bit more. So Citi downgraded JP Morgan to neutral, as I'm sure you know, earlier this week. They offered 3 points on the banking stocks going into earnings season. I'd like your top pick out of these three. Funding pressures impacting the net interest income outlook. That was 1. 2, regulatory reform pressuring longer-term return profiles. And 3, one I've heard a lot about, credit quality concerns ahead of an economic downturn. What's the one thing out of those three that you'll be focused on tomorrow morning?
I think the reason I'm going to be focused a lot on that credit quality is because everyone else is focusing on the other two so very much. We're going to watch credit quality not just among the biggest banks, but into the credit card companies, into the regional banks with auto and other types of businesses that have very clearly been pressured. The question then becomes, into this part of the cycle, how much are they pressured? One more very quick thing here, John. There's some news items here today ahead of next week's earnings with Morgan Stanley and Goldman Sachs. You have Goldman Sachs selling $1 billion worth of Marcus loans to a private credit manager. That matters for Goldman because it helps them pivot away from that consumer story just a little more at a time where we're thinking about credit quality very severely, and we've seen them been hurt by credit quality in the past.
Sonali, thank you. Looking ahead to tomorrow, Wells Fargo, Citi, JP Morgan. On to next week, Bank of America, Morgan Stanley. On the 19th, rounding things out with Goldman Sachs. Tomorrow morning, we'll break down those JP Morgan numbers. Wish Sonali Basak on Bloomberg Surveillance. First thing tomorrow should be around 6 to 7 a.m. Eastern Time. The broader market looking pretty decent this morning. Early days, I know, but about 21 minutes into the session, equities are up once again for a fourth session on the S&P 500. We advanced by 0.55%. They're the gains you see on the S&P, gains on the NASDAQ as well, helped out by this move in the bond market following economic data yesterday and again today this morning. Yields are lower by about 10 basis points on a 2-year. Your 2-year 464, call it 465. Last week as high as 5% plus off the back of pretty robust jobs data and a blowout ADP report, pushing yields a little bit lower. This morning, of course, PPI and yesterday CPI. So basically, complete reversal from last week. So yields lower, dollar weaker. The euro right now, 111.92. The euro positive by 0.5% and very close to new highs for 2023. That's the cross-asset price action. Let's get you some sector price action. Here's Abby.
Well, not surprisingly, John, based on that cross-asset action, especially yields, we have a risk-on tone for stocks, especially from a sector composition standpoint. All of the mega-cap tech sectors, well, those are the top sectors, each up about 1% or more. Communication services leading the way, helped out by Alphabet and Meta. Interestingly, on bottom, utilities and real estate. Now, it makes sense from the standpoint that it's risk-on, that these less risk-on sectors are on bottom, but those dividends should look more attractive with yields plunging over the last couple of days. But investors looking past that and piling into big tech. The NASDAQ 100 up for a fourth day in a row. As for the month so far, well, communication services has it. It's the best sector, again, helped out by both Alphabet and Meta. Folks seem to want in on these stocks. And I think one thought on Google, John, is the idea that it's a catch-up stock. It's only up 38% this year, but compared to Meta, up 160%. Some folks are looking for the laggard.
Abby, thank you. Your trading diary up next.
Back in 1997, I was interested in the following question, which is, there are a bunch of the dinosaurs called sauropod dinosaurs, which had really long, skinny necks. So Apatosaurus is an example. They also had really long, skinny tails. So I made a computer model that showed that, in fact, the tail of these sauropod dinosaurs could actually act like a whip. A bullwhip. Now, the way a bullwhip makes that cracking noise is because the tip of the whip actually goes about twice the speed of sound. Okay. I think the way they got a date was to impress the females by making loud booms.
This is Bloomberg.
Five minutes into the session, four-day winning streak, longest winning streak in about a month since the middle of June right now. Equities up by 0.6% on the S&P, on the NASDAQ up nicely, up by more than 1 full percentage point. With the yields lower, the data better, equities so far doing okay. That's the price action. Here's the trading diary. Coming up, President Biden speaks at 10:30 Eastern Time alongside the Finnish president. Fed Governor Waller speaking at 6:45 Eastern Time tomorrow. G20 finance ministers kicking off their four-day meeting over in India. And it's the big one for us tomorrow morning. Bank earnings begin. JP Morgan, Citi, Wells Fargo ahead of more results next week from Bank of America, Morgan Stanley and Goldman Sachs. From New York, with equities higher by about 0.5% on the S&P. That does it for me. Good luck for the rest of the trading day. Thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
thought maybe I should go do something else. I can't do anything better than I'm already doing. I already turned this company around. I've made a lot of money for the investors, the shareholders, and yourself. Are you happy doing this? You're going to do this for the foreseeable future?
I'm going to do it for the foreseeable future. I love what I do, and the reality is we've accomplished a lot. As you described, we've made Blackstone a lot of money. We made our shareholders a lot of money. More importantly, we've grown the business, and we've been a huge engine of opportunity. If you think about all the jobs we've created around the world, all the communities we've made better places, all the ownership groups who we've helped grow their business, and having built a world-class culture, the opportunities we've created for upward mobility for people. And this business, I would still say, is like a coiled spring coming out of COVID particularly. So I feel like we just have more to do. My job's far from done.
News breaks. No one covers the world like Bloomberg.
On the AI question, what we don't really see is Apple doing a knee-jerk response and moving into the domain of generative AI.
Supporters of President Recep Tayyip Erdogan celebrating late into the night, dancing and singing.
We have a fundamental reassessment of everybody's capacity within OPEC. Should we talk about $95 and $100 oil again? Not for a while.
Bloomberg, your global business authority.
From New York City,
From London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
This is Bloomberg Markets with Paul Sweeney.
We got a lot of green on the screen here, but the volume is light. This is a market that's much more optimistic or bullish than maybe the central bankers are. 9.5 million job openings. What are people doing? Are they just sitting in Starbucks all day?
Breaking market news and insight from Bloomberg experts.
There's still some concern out there in the market that there is room for things to deteriorate a little bit more than what they're indicating.
As small and medium-sized businesses struggle, they don't present as much competition.
What are you guys thinking about hardware, software? How should investors approach this thing called AI?
This is Bloomberg Markets with Paul Sweeney on Bloomberg Radio.
Good Thursday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. Some more data today confirming that inflation is in fact on the decline. What does that mean for the Federal Reserve coming up? We'll break that down. Plus, we have a big tech talk today. We're going to talk about Huawei. They have their 2023 Innovation and IP Forum at their Chinese headquarters. That's today. We've got a couple of the leading executives there at Huawei to join us to talk technology. Let's talk something AI. Is that a thing? We'll talk about that coming up. But first, let's go to Denise Pellegrini and get a Bloomberg Business Flash.
Hey, Paul, we check the markets all day long for you here at Bloomberg. It's 10:01 on Wall Street. We do have a little bit of a rally going on another sign. Inflation is easing. As you mentioned, U.S. producer prices, they rose at the slowest pace in nearly 3 years. The producer price index for final demand rose just 0.1% from a year earlier, according to the Bureau of Labor Statistics. And on a monthly basis, the PPI also increased slightly. But on the other hand, a report on first-time jobless claims showed fewer people than expected filed for claims, and that does show possible continued strength in the labor market. And Torsten Slok, chief economist at Apollo, says the labor market is certainly still flashing warning signs on inflation and the Fed.
So in that sense, there's still a very strong labor market. Average hourly earnings last Friday went up, and this labor market, obviously in jobless claims, still looking relatively tight, which certainly also get the Fed to say, well, we still need to hike rates more, and still tighter monetary policy is needed.
And Slock there on Bloomberg Radio and Television. We do have a mini rally going on. Stocks higher. The Dow up 99 points right now. That's about 0.2%. The S&P 500, it is up 24, about 0.5%. The Nasdaq, the big winner once again on the day, up just about 133, 144 points. That's almost 1%. The yield on the 10-year Treasury right now, 3.8%. We also have crude oil falling today. Crude oil right now down. Well, it's a little bit higher right now on NYMEX crude, but it's been lower for most of the day. Gold, spot gold, it is higher. And some strength in the air for airlines. Delta sees global travel pushing summer profit past expectations. Carrier beat earnings expectations. It's raising its full-year guidance. CEO says there will be significant growth in demand. Delta shares soaring on that news. And are you grabbing more snacks lately, Paul? Because PepsiCo...
Sure.
boosting its sales and earnings forecast. Are you a Gatorade fan, though?
I'm a monstrous Fritos fan.
All right, so you're
The
busted
chip of choice.
here. Yeah, they can thank you up in purchase because it's all seeing strong demand for all of it. Lay's potato chips, Gatorade, Fritos, Mountain Dew. I don't know if you like that one, but all showing resilience, even though they're charging more for it. Consumers, even though the pandemic is over and people aren't sitting at home eating those snacks anymore, they're still buying that stuff. And shares of PepsiCo are also higher. And that is your Bloomberg Business Flash. Paul.
All right, Denise Pellegrini, thank you so much. We appreciate it. Madison Mills, Paul Sweeney here in the Bloomberg Interactive Broker Studio. And, of course, we are streaming on that thing called YouTube. You can just go to YouTube and search Bloomberg Global News, and that'll get you where you need to go. Let's look at these markets here. A nice move, as Denise was just reporting. Nice lift to the marketplace following up on yesterday's gains. Let's break it down with a Bloomberg Equities reporter, Carmen Reineke. Carmen, what do you got for us?
Yeah, so one of the biggest movers that we're seeing this morning is Viasat, ticker VSAT. It's a satellite communications company, and it's down as much as 36% today. That's on track for a record drop if at the close if this holds. The company said last night that an unexpected event occurred during the deployment for one of its communication shuttles, or satellites, excuse me. So, obviously analysts and investors aren't feeling too good about that. Sort of on the flip side, at least one analyst from William Blair said that this might be largely emotion-driven. There was no change to coverage for customers, and the company is working on a quick fix, and it also has a lot of other satellites sort of in the mix.
Yeah, I've looked at this. I've covered the satellite business in the past. You don't like to see any of these technical glitches here because you just don't know how bad it's going to be. And Raymond James analyst Rick Prentice, who's one of the best in the business, he says, this concerns me. This could be a problem because, this is, as we do more and more stuff online, put more and more stuff into the cloud, you need more broadband coverage.
Well, so do you, Paul, have any insight into what the unexpected event is here? Because they're being super cagey. We were talking about this before we were on air. What does that mean?
They're talking about reflector deployment, so I'm thinking about some of those, reflectors that, use it for maybe to get solar energy or something like that. So it just, and they deploy over time, and if you have a glitch, it kind of impacts the capability.
Well, and another analyst noted that this particular satellite has already seen a very long road to even being launched into space. It just launched on a SpaceX shuttle at the end of April.
Okay. All right.
So that's, certainly disappointing for investors as well after,
it's a high-risk sector. It's a high-risk. It used to be a lot more much more high-risk when the satellite technology and the rockets, when you're shooting them off French Guiana, you could have a lot. This is a NASA launching satellite, so it can be a little bit risky. Anyway.
Yep. You know this space, Paul.
It's fun.
You really do.
Well, in other space news, we're also seeing Virgin Galactic up a little bit. It just announced the target date for its second commercial flight. So shares are up a little bit. This will take 3 private passengers into space, and the window will open on August 10th. One thing that's interesting, Virgin Galactic, we always kind of see this kind of price action around it announcing these windows for space flights, but then on the actual launch, at least the last one, we see the shares fall. So this is kind of an interesting, investors are sort of trading the headline a little bit ahead of what's going on. And then another really interesting one that we're seeing this week, I think everyone's sort of heard about this, is Amazon. Obviously, it had Prime Day wrapped up over the last 2 days. Shares are about 2.5% higher right now. And yesterday it announced that at least its first day of Prime was one of the biggest sales days for it, so
Connection
that's
lost.
obviously given some shine to the shares. We've also seen a lot of other retailers kind of jumping in on this trend. So, you know, big box stores, other online retailers have like competing sales that, you know, coincide with Prime Day. So I think that's just a big deal for
Alibaba
the
has
industry.
singles. Right?
Yeah,
Singles
exactly.
Day.
Yeah. 7-Eleven.
Yep.
This is also, it's interesting because in the last 4 years, Prime Day hasn't really been a catalyst for Amazon shares. Usually in the week, you know, of Prime days, it falls. And so this year, you know, it's on track to gain. And it for whatever reason, I mean, maybe, you know, because it's showing consumer strength or optimism, it is actually giving Amazon shares a lift.
Yeah,
So
we were talking
kind of
about that on the
interesting.
show earlier this week, just that the stories, particularly with Amazon stock, is about AWS, cloud services.
Yeah.
But it's giving a lift to the overall retail sector on the S&P as well. So seeing a lot of strength in the retail space that we haven't seen these past couple of months.
Exactly.
And I mean, my household really contributed to that, Carmen. I don't know about you, but
Exactly,
it was
yes.
brutal for me when it came to Amazon Prime shopping.
All right, we got some earnings tomorrow. The big banks report earnings, so that'll be big. And again, I always look forward to listening to and reading the comments of Jamie Dimon, because who's got a better view of the global economy than Jamie Dimon, and he has no filter. He'll say whatever he thinks. So we'll pay attention to those earnings tomorrow.
Yep, exactly.
All right, great. Carmen Reinecke, thank you so much for joining us. Carmen, she covers